this video, I will cover different trading strategies and techniques, the type of trading strategies that exist, and some important trading terminologies that you must be familiar with. Let's begin with what trading strategies and techniques are. In simple terms, a trading strategy is a set of rules that a trader follows in order to make some profitable trades in financial markets, no matter what, if it is cryptocurrency market, if it is stocks market, commodity markets, or any other market. These rules can be based on technical analysis, fundamental analysis, or a combination of both. Trading techniques, on the other hand, are specific methods or tools that traders use in order to implement their trading strategies. Now let's move on to the different types of trading strategies that exist. But before that, I must tell you, whatever example I make here are just examples. I don't want to break down anything right at the moment. These are just examples. How they get done, we're gonna have a specific, dedicated session or sessions to each and every one of them. And we're gonna talk about different trading strategies one by one in detail, so don't worry. One of the most common trading strategies is trend following, which involves identifying a trend in the market and then buying or selling based on that trend. Here's an example. First, we need to find a trend and mark it with trend line and find if it is in a channel or not. There are some rules to do that, which I'm going to talk about later, like this. Then on the bottoms, we're going to buy, and on the tops, we're going to sell. Buy, sell, buy, sell, buy, like this. And then we're going to take the profits out of the market. Another popular strategy is mean reversion, which involves identifying when a security is overbought or oversold, and then buying or selling accordingly. Here's an example. In order to do this, we need some indicators like this one here, and it shows us if the security is in overbought zone or oversold zone. Then we're going to decide according to our trading strategy whether we want to buy or sell. Other trading strategies include momentum trading, which involves buying or selling based on the speed and direction of a security's price movement, and scalping, which involves making numerous small trades throughout the day in order to profit from small price movements. There are many more trading strategies out there, but these are some of the most popular ones. Now that we've covered different types of trading strategies, let's talk a little bit about different trading terminologies. The first thing you must be familiar with is leverage, which is the ability to control a large amount of money meanwhile you're having a small capital account. Leverage can be a really powerful tool for traders in order to take really good profits out of the market, but in the meantime it can be really risky and increase their chance of risk and the chance of losses, big losses, of course. So we're going to talk about this in risk management sessions and working with exchanges, don't worry. But to break it down a little bit for you to know what leverage is, it means if you have $100 and you use 10x leverage, it means you time your both profit and loss in 10. So if your profit or loss for $100 is going to be 1% in general, and you use 10x leverage, it means if you get the profit instead of 1%, you get 10% out of the market. And if you lose, you're going to lose 10%. Another important term is margin, which is the amount of money that a trader must deposit in order to hold a position in the market. Margin requirements can vary depending on the broker or the exchange and the market being traded. You should also be familiar with terms such as long and short. When a trader takes a long position, they are buying a security with the expectation that its price will increase.
Let's take a look at this example here. So my prediction was that the price goes up. I take a long position in the broker or the exchange, whether I want to trade crypto or stocks or other markets. So if it goes up and hits my target, then I'm going to come out of that trade with profit. Otherwise, it's going to be a loss. When they take a short position, they are selling a security with the expectation that its price will decrease. So let's take a look at another example for this time for short position. So here's a short position. As you can see, it's exactly opposite of long position. We just locate a position that think that the price will go down from there. How to do that, don't worry, we're going to talk about that later on, but we're going to take a short position. So short means selling, long means buying. From now on, we are going to use these words instead of buying and selling: long and short. Long buying, short selling. Other important trading terminologies include stop loss, which is an order to close a position if the price of a security reaches a certain level. What does it mean? It means I enter a position with, let's imagine, $1,000. The amount of loss which I can bear and I can tolerate is $100. And I don't want to lose more than $100 during this trade or after this trade, let's say. So I set a stop loss when I want to take a trade, and I set the order. I give the order to the broker or the exchange that I do not want to lose more than $100. I don't want to lose more than this. I cannot tolerate more loss than this. So if the price goes against your position, so you have a long position and the price goes against you, it's going to hit your stop loss. So you are going to lose some amount of money which you can tolerate. But if you don't lose a stop loss, the price will go and can keep going. And in that case, it can just wipe out your whole account. And that happens, and it still is happening to lots of people who are not using stop loss. How to do that? We're gonna learn how to do that in risk management sessions. Don't worry, we have a lot to talk about that, a lot, believe me. And take profit, which is an order to close a position when a certain level of profit has been reached. So it's exactly like a stop loss, but it's for profit, not for loss. So we're gonna set an order and tell the broker and ask the broker or the exchange to close the position after reaching a certain amount of profit.
In conclusion, understanding trading strategies and techniques is an important part of being a successful trader. By knowing different types of trading strategies that exist and the important trading terminologies, you can develop your own trading strategy and implement it effectively. Thank you for watching this introduction to trading strategies and techniques. If you like the content that I'm creating for you, please hit the subscribe button, turn the notification bell on, so you're going to be the first one to be informed when I'm going to upload a new video. Please share my videos with your friends so they can get the benefit out of this free and effective course to how to become a trader. Is about technical analysis strategy focusing on chart patterns. In this video, I will discuss different types of chart patterns and how to use them in order to make informed trading decisions. I will be dividing these patterns into two categories: reversal and continuation. Watch this video until the end, because just before the end of it, I have a critical point and tip for you. But if you haven't watched my previous videos, because they are related to this one and they are necessary to be watched before you watch this one, so this video is not for you. Please go check them out first. I'm gonna leave the link in the description below, and afterwards come and check this video so you know what I'm talking about exactly. But before getting
into anything, talking about the patterns, we need to get to know some definitions. First is support and resistance areas. What is a support and resistance area? We're going to talk a lot later on, but for now, we only need to know there are some places which the price has some reactions to them. I talked about this previously. Not briefly, it was just a glimpse. If you haven't checked that video, I'm going to leave a link down in the description. But again, I'm going to just point out to it really quickly. So when you see the price, for example, goes up and then at a level, it rejects and goes back down, or vice versa, the price goes down and it reaches a point, and then from there it changes its direction and goes the other way, of course upwards, or goes sideways. We call these points, these areas, support and resistance areas, which can be static, which are just horizontal lines, or they could be dynamic, which are they can be in angles. The other definition which I want to talk about is higher highs and higher lows. So when the price is in a trend and it goes up as an uptrend in a, let's say, a bullish market, we have higher highs. So the price goes up and down, up and down. So it makes higher highs, which we know them as double H, and higher lows, and we know them as HL, and then vice versa for a downtrend or a bearish market. So we use these a lot in the upcoming sessions. I just wanted to point out them really quickly, but we're going to go for more details in the upcoming sessions. Alrighty, let's start with reversal patterns. The very first and well-known one is head and shoulders. The head and shoulders pattern is a popular reversal pattern that indicates a potential trend reversal from bullish to bearish. The pattern is formed when a stock, crypto asset, or security price rises to a peak and then drops, followed by a higher peak and another drop, creating a shape that looks like a head and two shoulders. These patterns indicate that the buyers are losing their strength and the sellers are taking control of the market. The same situation is happening for inverted head and shoulders, but everything is in opposite situation. Traders often use the head and shoulders pattern to make sell orders, which signals a potential market downtrend. Is important to wait for confirmation of the pattern, such as a breakdown of the neckline, before making a trade. Here's an example how it gets done. Okay, here's a really good example of a head and shoulders pattern. If you take a look at it, it is not always that classy as you see them in the books, or you can find some pictures on Google. But after some time you watching the market for yourself, you can realize them as soon as you see them. So if we just take a look at here, you can see it. There is a head and shoulders happening here. So let me just for a moment remove candlesticks, and you can see it is exactly like our head and shoulders with a beautiful neckline here. Right, change the color. Even though if you are not familiar and of course your eyes are not friendly with the chart patterns, I recommend you to, if you want to find them quickly, you can change your chart mode from candles to lines. So switch to a line chart. Now you can see it is more obvious and it is more like a head and shoulders. So how we just take a trade with it, and how can we understand how it works, I'm talking about that right about now. It happens, the first thing that we want to know that if it is head and shoulders or not, because sometimes you see a patterns, it is almost like it, but it's not. First, there must be a sharp movement of the price going up. It goes down and again up and down. And if it is not a sharp price movement, it is not a head and shoulders. You cannot call that a head and shoulders. If the price coming from a range market and then something like head and shoulders happen, it is not a head and shoulders. So in this case, we have a sharp price movement going up. So I'm going to mark it like this. Then it goes down. Again, it goes up and down and goes up again and it goes down. So in this case, let me change the color here. What should we do? It is really simple how it gets done. We can just set a neckline like this, and then we wait for the price to break the neckline to the bottom, going more down like this in here. So what should we do? How much the price will go down? If we can just determine the distance from the peak of the head to the neckline and then put it on the neckline, we can see that the price will at least, I repeat, at least goes down this amount. So if I want to take a trade, let's say if we take a trade here, set our stop loss here. If you don't know what is a stop loss, what is long, what is short, you have to watch my previous videos. I told you there is a link in the description. Don't miss it. So I don't want to waste any more time talking about them again. If I put it here, the price will touch this target point here. So let me switch to candlesticks again. And you can see that the price easily as a piece of cake touched our target point, and not even touched our target point. It went further down. As I told you, at least the price goes down as much as the distance from the top of the head to the neckline, it will go down. So I switched back to line chart to determine an inverted head and shoulder for a long position this time. So I've encountered one here. I told you it is not as beautiful as it is in the books, but after a while you get used to if it is a pattern or not. You can see the price movement was a sharp movement to the downside. It was a bearish market. Then it went up, came down, went up, came down, and it continued. So it is an inverted head and shoulders. Let me make the lines disappear. So you can see, yes, it is. If I put a neckline here, just like the head and shoulders, this is the opposite side for long positions. So how much the price will go up? Again, we determine the bottom of our head and shoulders, which is the head, to the neckline, and then the price will go after the breakout, the neckline, the price will go at least to this point. So let me set this point as our target point. If we take a trade here and set our stop loss here and set our target point here, let's remove everything and see if the price hit our target, and switch to candlestick chart. And as you can see, yes, it reached our target point. And it was a 0.98%. If we use the leverage like 10x, it was like 9.8, almost 10% of profit, which is crazy good. How do we do these? How to set a stop loss, where to put it, what is the best target point? We're going to talk about this later on a lot, but we just want to know how the chart patterns work. I need you to go to your own chart, bring your chart up, and try to determine and find as much as you can in different time frames. If you don't know how to switch in between time frames and how to do them, I leave a link above here. I talked about it previously. Watch that video to know how to work with TradingView, how to switch in between timelines, how to use these tools here. The next chart pattern which I want to talk about is the double top. The double top pattern is another reversal pattern that indicates a strong resistance level. As the name suggests, this pattern is formed when a stock, crypto asset, or security price rises to a certain level, drops, and then rises again to the same level, only to drop again. This pattern indicates that the buyers are struggling to push the price higher, and the sellers are gaining control of the market. Traders often use the double top pattern to make sell orders, or let's say short orders, as it signals a potential market downtrend. Important to wait for confirmation of the pattern, such as a breakout of the neckline before making a trade. Before making some examples, I want to tell you about the double bottom, which is the opposite of double top. The double bottom pattern is a reversal pattern that indicates a strong support level. This pattern is formed when the price of a stock drops to a certain level, rises, and then drops again to the same level, only to rise again. This pattern indicates that the sellers are struggling to push the price lower and the buyers are gaining control of the market. Traders often use the double bottom patterns to make buy orders as it signals a potential uptrend in the market. It is important to wait for confirmation of the pattern, such as a breakout of the neckline, before making a trade. So exactly like the head and shoulders, because you're new to TradingView and your eyes are not used to see those candlesticks, you can switch the chart to line chart. Then you can see how easy it is to determine different chart patterns. In this case, I have found an example of a double top for you. Exactly like head and shoulders and inverted head and shoulders, there must be a sharp movement to the upside, and then the price goes down and then goes up again and goes down. So we set a neckline here. The price must break the neckline, and then how much the price will go down? We choose the left shoulder, or let's say left top. And because why left top? Because sometimes they are not in the same level. But it is not really that important. We just determine the distance from top to the neckline, and then we put it here on the neckline, and the price at least goes this amount down. So let's take a short position here and see if the price goes that way and hits our target. Yes, it has, but let me switch to candlesticks chart. As you can see, the price easily touches our target point. In the case of a double bottom, I don't switch to line chart because I want you to do the same. After time working with line chart, you have to switch to candle chart because it's a lot better to see the price movements. So there was a sharp movement to the downside, and then the price went up, then go down again, and it wants to go up. So we put a neckline here and wait for the price to go above it. And then we take a long position here. And how much the price will go up? Okay, left bottom. And we determine the distance from the bottom to the neckline. And let's make it straight like this. Then put it here, and the price at least goes this amount high. And it went a lot higher, but it was our target point and it reached it. So I need you to go to your own chart and find examples like this and practice. And if you have any questions, feel free, don't be shy, ask me in the comment sections. Another reversal pattern which I want to tell you is cup and handle. The cup and handle pattern is a more complex reversal pattern that indicates a potential trend reversal from bearish to bullish, and of course vice versa for inverted cup and handle. This pattern is formed when a stock, crypto asset, or security price rises to a certain level, drops, and then rises again to the same level, forming a cup shape. After this, the price drops again, only to rise slightly to form a handle shape. And of course, everything is opposite for inverted cup and handle. Traders often use the cup and handle pattern to make buy orders, or let's say long orders, as it signals a potential uptrend in the market. It is important to wait for confirmation of the pattern, such as a breakout of the resistance level before making a trade. Now let's go to the chart and make some examples. As I told you, it's a more complex pattern, so I changed the chart to line chart so you can see it in a better way. If you put a line here, you can see how this cup and handle works. This is our cup, and this is the handle. You see, it's the cup and it's the handle. How much the price will go up? It's really easy. We can just determine from the bottom, the very bottom of the cup to the neckline, like this. And then the price after breaking the neckline goes up at least this amount. So if we took a long trade here, with our stop loss here, and you can see it easily, just piece of cake, the price hits our target just like that. Let's make an example for inverted cup and handle. Okay, here's an example of inverted cup and handle. I really don't expect you go find them easily, because especially cup and handle and inverted cup and handles are really rare patterns to happen, especially when you're looking for them in higher time frames, because the frequency is really low. I might say it took for me for like a couple of minutes to find. So in this case, you can see this is our inverted cup and this is the handle. If we set the neckline here, how much the price will go down? We said it's really easy to determine. We just set this distance from the top to the neckline, then we wait for the breakout, it goes down this much. So did it hit our target? Yes, of course it did. So it's like this. If we took a short position here, our target was here. So again, go and find them for yourself and try to practice as much as you can, and just ask me any questions which pops up into your mind. Now that we've covered the most important reversal patterns, it's time to talk about continuation patterns. The first one is triangle, ascending and descending. The triangle pattern is a popular continuation pattern that indicates a potential trend continuation. This pattern is formed when the price of a stock creates a shape that looks like a triangle, with either an upward or downward trend. The ascending triangle pattern is formed when the price makes higher lows and forms a flat resistance level. The descending triangle pattern is formed when the price is making lower highs and forms a flat support level. Both patterns indicate that the buyers and sellers are in a state of equilibrium, and the market is likely to continue its current trend. Traders often use the triangle pattern to make buy or sell orders, depending on the direction of the trend. It is important before making a trade to wait for confirmation of the pattern, such as a breakout of the resistance or support level. Let's take a look at some examples on the chart. Here's an ascending triangle. Where is it? Let's draw it first. We have this resistance area. It means that the price is resisting to pass this point, which we're going to talk a lot about this later on. And then we have a support area. We call it a dynamic support. We have two types of support and resistance areas. We're going to talk about this later on. Don't worry. But this is a dynamic support. So the price is supported by this area. If I continue this, so you can see it's a triangle, and then the price breaks it, and how much the price will go up? In this case, price will go at least the amount of this point to this point. It will go up from here, and you can see the price went a lot above that. No one knows how much a price will go up, and because this is an unpredictable market. But if we took a trade, we took our profit and we came out of the trade for ourselves. So if we took this trade, how much was it? It was a long trade like this here, and our stop loss was here, and our target point was here. And it was a pretty good amount of profit. So forget about the risk movement of the market. So it was our share of the market. And we're going to talk later on about the psychology of the market and risk management, money management. And we're going to learn that not all the profits in the market is for us. We just want to take our share and come out. So in this case, it was really good profit. So here's an example for a descending triangle. This is the bottom of our triangle. And so this is the support level and the resistance level here. You can see as soon as the price breaks it, how much it will go down. We said we determine this distance here, we put it here, And did it hit our target? Yes, it did. If we took a trade here, set our stop loss here, the flag and pennant patterns, which are really close to each other, and I call them the same myself. I do not believe that there are so much of a difference in between them. It is just something that with different names, but they are more or less the same. There are also continuation patterns that indicate a potential trend continuation. These patterns are formed when a stock, crypto asset, or security price rises or falls rapidly, and then forms a small flag or pennant shape before continuing its trend. The flag pattern is formed when the price makes a sharp move up or down, followed by a consolidation period where the price moves in a parallel channel. This pattern indicates that the buyers or sellers are taking a break, and the market is likely to continue in the same direction after the consolidation period. The pennant pattern is similar to the flag pattern but has the more triangular shape, indicating a stronger trend continuation signal. The pennant pattern is formed when the price makes a sharp move up or down, followed by a consolidation period where the price forms a triangle shape before continuing its trend. Traders often use the flag and pennant patterns to make buy or sell orders, depending on the direction of the trend. Before making a trade, it is important to wait for a confirmation of the pattern, such as a breakout of the resistance or support level. Now, let's take a look at some examples on the chart. Okay, here's with a really good example of flag pattern. So as you can see, there is a support level here, a dynamic support level here, and there is a dynamic resistance level here. Let's make it more chic like this. So as soon as the price breaks above it, and you see there was a sharp movement from here. So how much the price will go up? It's really easy. We have to first find the first that the price moved to the upside from here to the top of the channel, this flag, and then put it to the bottom of the flag, and then see the price will goes up. So we wait for the breakout like this here, and we set our stop loss on the last low here. Did it hit our target? So our target was here. Yes, it did. You can say it's here. Here's with another example. This is this time for a continuation to the downside. So we had a sharp movement to the downside here, and then we had a stop of the price with the support and resistance like this. How much the price will go down, we determined first when the prices started to come down. So it was here to here, and then we put it here, and it hit our target. And the pennants work just like the flags. You can just go find for yourself. If you have any questions, again, just ask me. I would be really happy to answer your questions.
Now it's time to pay my dues and talk about the golden tip which I told you in the beginning of the video. You are not allowed to use only these patterns to make trading decisions. We only can use these, of course it depends on our trading strategy in the future, but we can use these patterns in order to take some confirmation, let's say make more sure of our trading and make a better trading decisions. But if you want to trade only with these patterns, believe me, it's not going to work out. So how we can do that? We have to combine it with our main strategy, which I will talk about in the upcoming videos. But as for now, you need to know these patterns because in the future, we have a lot to talk about them. I hope you like this video too. If you really do, please like the video, hit the subscribe button if you haven't yet, and share my video with your friends so they can take the benefit out of this free course for themselves too. If you have any questions or you want me to talk about different things or focus on a specific thing, please just tell me in the comments below. I would be really happy to answer your questions one by one. That's my pleasure. Thank you. See you in the next one. In this video, I will talk about support and resistance areas in technical analysis. I will be discussing how to identify key levels of support and resistance using supply and demand zones, and how to use this information to inform your trading decisions. Watch this video until the end, because just before the end of it, I'm gonna tell you a really golden point which is going to be handy and becomes really useful in the future of your career as a trader.
But what are support and resistance levels really are? Before getting into more details about them, if you haven't watched my previous video, please go check it out, because I pointed out different types of support and resistance, like statics and dynamics ones. But in this video, I'm going to cover up only static support and resistance levels. And the dynamic support and resistance levels will come up, and I will talk about them briefly, while I will talk about the technical indicators in upcoming sessions. Support and resistance levels are key price levels in technical analysis that represents levels of supply and demand for a particular asset. Support levels are price levels where buying pressure is stronger than selling pressure, causing the price to bounce back up from that level. Resistance levels, on the other hand, are price levels where selling pressure is stronger than buying pressure, causing the price to bounce back down from that level. Supply and demand zones are areas on a price chart where the price tends to stall or reverse. These zones are created when there is a significant amount of buying or selling activity at a particular price level. To identify supply and demand zones, you can look for areas on the chart where the price has stalled or reversed multiple times. Support levels are typically found at the bottom of a price chart, while resistance levels are typically found at the top. To identify a support level, look for an area where the price has bounced back up multiple times. On the other hand, to identify a resistance level, look for an area where the price has failed to break through multiple times.
Now that we have identified the key levels of support and resistance areas using supply and demand zones, let's talk about how to use this information in our trading decisions.
All right, we are here on the chart, and we want to find some support and resistance areas. In order to do that, I recommend you to switch to lower time frames, because the frequency is higher. But later on, we're gonna combine the time frames in our trading strategies. But now on, we just only want to know how to find these areas. First, what we need is a tool, this tool, which is in rectangle. How can you find that? It's really simply can be found here. If you click on this arrow here, just close to the right hand side of this brush, then you can find it here, and you can make it favorite, and it will become up here. Or if you need any other tools, you can just do the same. How can we find them? So as we talked about that previously, we have to find the areas that the price had reactions to during the time. So here you can see that the price bounced off to the upside. So we can just mark this area as a really strong and good support level. And then we can mark this area as the resistance level, as easy like that. Let's do the same for somewhere else in the market. If you haven't checked my video on chart patterns, please check it out. I'm leaving a link above here. Really recommend you watch that, because we have a lot to do with after we learn the supply and demand zones, or let's say support and resistance areas, and then we're going to combine them with the chart patterns and candlestick patterns, and we're going to come up with really good and strong trading strategies. Let's get back to our main subject. So here's a good place. So you can see that the price during the time hit this area a lot. So we can, why are we saying area? Because in the next upcoming session, I will talk about candlesticks, and you will understand that the price is not going to just hit a point or a dot on the chart and then come back, bounce off from there. We have to determine an area which the price may go in and come back from. Then, as you can see, in this case, price hit this point, this area 1, 2, 3, 4 times, and one time even penetrated within it, and then came back down again, and then it could manage to break it through eventually. But why should we do this, and why should we understand these areas? Why sometimes price break a supply or demand zone and come back in? We're going to talk about this later on, but now you only need to know what are the supply and demand areas, and this is as easy as this. And you have to be aware of the fact that the zones and these areas are going to be switched. They're going to transform to each other. What does it mean? It means if one area is going to be lost, it's going to reform itself. It's going to transform to the other factor. So if it is a resistant level, it's going and it's going to be broken to the upside, then it's going to turn into a support level. Let's make an example here on the chart. As you can see, we had lots of resistance here, and then the price broke this level. Price broke this level and went up. And then this area, which was a strong resistance and didn't let the price to go through, afterwards, it became a really good and strong support level, supporting the price going up. And you see, and the same story happened again. Here we had a new resistant area. It didn't let the price go up. It went back down, supported here, went up again, and then broke it through and went up. Now we are expecting this previous resistant area after breakout becomes a new support level, which I'm going to talk a lot in the future, because we're going to base a lot of our trading strategies on these support and resistant areas, supply and demand areas. But in this session, I only need you to know these things which are really important to know. And let's say there are millions of ways out there. Getting help from indicators or just find them by your own eyes, how to determine and find supply and demand zones. But this is one of the most popular and reliable methods to find the supply and demand areas. It is really easy to work with. You can even use some indicators to indicate the places which the price bounced off from or had some reactions to. But this is the very most reliable method which I am using, which lots of people are using, and you can use it too. But I'm going to show you the other methods in the upcoming sessions when we're going to reach the indicators, technical indicators. No worries. And again, if you have any questions, or if you want me to talk about the specific thing or focus on something or repeat something, just ask me in the comments below. I would be really happy to answer your questions one by one and focus on the things which are bothering or making you busy-minded. When the price approaches a support level, it can be a good opportunity to buy the asset or go long, as there is likely to be buying pressure at that level that will cause the price to bounce back up. However, if the support level is broken, it could indicate a shift in market sentiment and a potential downtrend. Similarly, when the price approaches a resistance level, it can be a good opportunity to go short or sell the asset, as there is likely to be selling pressure at that level that will cause the price to bounce back down. However, if the resistance level is broken, it could indicate a shift in market sentiment and a potential uptrend. It's important to keep in mind that support and resistance levels are not always exact and can be breached or broken, which we call them breakouts, fake breakouts, and I will cover up everything about those in the upcoming sessions. But as for now, especially in volatile markets, they can trick you a lot. It's also important to use other technical indicators and fundamental analysis to inform your trading decisions, which we're going to sum up all of them after some couple of sessions, while we want to come up with different trading strategies for different types of the market.
In conclusion, understanding support and resistance levels can provide valuable insights into market trends and inform your trading decisions. By identifying supply and demand zones and using this information to analyze price movements, you can increase your chances of making profitable trades. Imagine yourself as a carpenter. In order to make a masterpiece of woods, you need different tools to do that. We previously talked about different tools. Now, today, I want to talk about technical indicators. What are they really all about, and what are different types of them? Technical indicators are mathematical calculations based on volume and or the price of an asset. They are used to analyze past market data, find the patterns, and predict the future movements of the price. Technical indicators are widely used by traders in order to make informed trading decisions and help them out to become more specific and increase the chance of their success. In the upcoming sessions, I will talk about different types of indicators, the most known ones, the most useful ones, although there are like thousands of them out there, and we can combine all of them together, use one or a couple of them together, coming up with different trading strategies. But first, we need to know the most popular ones. How do they work? Then combine them with the previous knowledge that we have. Then combine it with risk management, money management, and afterwards, we can come up with different types of trading strategies for plan A, plan B, all the way to Z if you want. And I'm going to help you out with that too. But here and now today, I want to introduce you the very first and most well-known trading indicator, moving averages.
Do you remember the time which I told you previously in the previous sessions when we wanted to talk about support and resistance areas, or let's say static support and resistance levels? Well, moving averages are one of the most common ways to determine and identify the dynamic support and resistance levels. And how we can use them? Let's continue and find out. A moving average is a widely used indicator in technical analysis. It is used to smooth out price data and help traders identify trends. The moving average is a line that represents the average price of an asset over a certain period. As you can see, there are different types of moving averages: simple moving averages or SMAs, exponential moving averages or EMAs, weighted moving averages or WMA, and many more. Each of these moving averages has its own unique character, and traders use them based on their preferences and trading strategy. As I told you beforehand, there are many types of moving averages which you can use, but the most common ones are SMAs and EMAs. During hundreds, thousands of trades I myself made, talking to other traders and watching them throughout my career, I realized that everyone is using EMAs, and I will tell you later on within this video why. The SMA is calculated by taking the sum of the prices over a certain number of periods and then dividing them sum by the number of periods. For example, if we take a 20-day, or in case of day, let's say candles, 20 candles SMA, we would add up the closing prices of the last 20 days and divide it by 20. Let's go to the chart and understand what is it all about. Well, first things first, this is the TradingView platform. If you don't know how to work with it, how to sign up, how does it work, I made a complete dedicated video and a session for this, which I'm going to leave the link down in the description. Go check it out. I highly recommend it because this is our main tool to work with. Beside exchange platform itself, which we're going to take our trades there, this is only for technical analysis. Both even we can use it for fundamental analysis too, which I pointed out that previously. So go check that video first if you haven't checked that yet. This video is probably not for you. Let's first find the moving averages. How can we find them? It's simply can be done. This is the Bitcoin to USDT chart. So let me remove my watch list from here, and you simply move here to indicators segment and you just write down moving, and then it's gonna pop up here, this one, moving average. As you can see, there are like tons of indicators, you know, endless numbers of them, and the list goes on and on. These are the other people, programmers, who wrote different types of them, but we only want to use this one. This is the default setting of any technical chart. It doesn't matter if you want to do your technical analysis in MetaTrader application, on TradingView, or on your exchange chart, but these are the default indicators. So we're gonna choose this one. You can make it favorite, so it's gonna be in your favorite list. Click on it, so it's gonna be on your chart. How does it really work? If you take a look at up here, it says MA9 close 0 SMA5. So what are these all about? Before getting to the settings, let me tell you something. What is an EMA doing? As you can see, it says close. So let me zoom in, go like this. So how a moving average actually works, it is really simple mathematics. In case of, for example, here, as you can see on top left here, the MA9, moving average 9, it means 9 previous candles. So if we count them like this is the today of the market, not current moment. If we take this, it is not closed. Candle must be closed to be calculated. So this is the reason that you can see the line of the MA, this blue line, ends here and it's not going further. It is a lagging indicator. It means that first the price must form, opens at a certain point, closes another certain point, and then the data must be collected by the indicator as a calculator, and then comes out as an exiting data, as you can see on the chart, as a line. So it means 1, 2, let's wait another 8 seconds, 7 seconds. This candle is going to be closed, and you see that the line is going to be moving forward for another candle. See? So here 1, 2, let me put an arrow counting them. 1, 2, 3, 4. You see here 1, 2, 3, 4, 5, 6, 7, 8, 9. So this candle here. It means what a moving average does, it says close. It means it is calculating the close price of these 9 candles and giving us one line as the average. So let me for a moment make the candlesticks disappear. So this line, as the name says, it's the average amount of the candle closes. So let me bring the candles back. This candle, I'm gonna put some marks on the chart, then we're gonna remove the candle. So it is this candle, as you can see, this candle here. It's a bearish candle, so it means the open was on the top, the close was on the bottom. If you don't know about the candlesticks, I have 4 dedicated sessions about them. I'm gonna leave the link both above here, down in the description. Check it out. But one here, and then another one was here, another close, then a bullish candle, so the close was here, and then another close here. I'm gonna just mark them: close, 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 and just like that. So if I remove the candles, you can see it means that this amount of travel, so like this, the price of the closes was here, then here, then here, 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 and then here. So this line, this MA line, moving average, is calculating the distance from this close to the next, to the next, to the next, and then calculating all of them, and then divide them to 9, and then this line comes up to your chart. Why the close of the prices? Why we are setting the close of the candles? Because a close of a candle means that the buyers or sellers, let's say the people, the players of the market, which I made another video about that previously, and you can check the link above here, they have decided on a certain point for the price of that particular asset. In this case is Bitcoin. It can be gold, it can be Apple stocks, it can be Ethereum, any asset within this market or any other market. They decided to for the price to be closed at a certain point. So what we decide must include the close of the price, because that was the price that people decided whether the market is going to be a bull market, or it's going to be a bear market, or it's going to be a range market. So this is the reason that we are choosing the close of the candles. If we go to the setting, as you can see here, we have different settings. First is the inputs. I highly recommend in the beginning of your trading career, especially during this course, coming up with me step by step, do not touch these settings. Leave them to the default setting. As I tell you, if we need to change any setting, I'm gonna let you know. But here it's a 9 period. It means previous 9 candles. If our time frame of the chart is set on 5 minutes chart, it means 9 times 5. So it is the amount of the time that it took for this moving average to form. Let me make it easier. If the line is here ending up here, another 20 seconds, is going to end up here. It means 9 previous candles. So if it is a daily chart, let me put it on auto. If it is a daily chart and you see 5 hours 45 seconds due to my time zone, it is left for this daily time. It means each candle takes 24 hours to be formed. It means this is a 9 M.A. It means each M.A. took 9 candles or 9 days. So if we go to hourly time frame, it means each M.A. forms due to the average close prices of previous 9 hours, or let's say 9 candles. Do not mess up your mind with these 9 watts, 9 depends on your time frame, trading time frame. So I choose 5-minute time frame. It means 9 times 5. I choose the 5 minutes time frame in order to have more movements in the market. Later on within this video, I'm gonna show you more of these examples. Another thing which I'm gonna tell you is the SMA. You can simply just write down SMA and then you can see it here. Smooth moving averages is here. Make it favorite, put it on the chart. As you can see, what is the difference between this one and MA? Let me bring back the MA, both of them, and put them both length of 9. So let me bring that back. You can see there are a little bit of differences because it is more smooth. If I remove the candlesticks, so the purple one is the smooth moving average. You see it doesn't have those sharp edges anymore and it is more smooth. Why should we use them? As I told you before, these are mostly used while we are using other indicators and they are written based on SMAs. Why? I'm gonna let you know later, don't worry. But SMAs, we do not use them on their own. I just wanted you to introduce you to them, and then I'm gonna talk about in the other trading indicators more about the SMA. The exponential moving average, or EMA, gives more weight to the recent price data. This means that the EMA reacts faster to price changes than the SMA. The formula for calculating EMA is more complex than SMA, but it is widely available in trading platforms. Now let's go to the chart and find some examples. The thing which I really like are EMAs, or exponential moving averages. This is the EMA, or exponential moving averages. How do they work? Exponential moving averages are basically the same as moving averages, but they are faster and they are, let me bring the moving averages. You can see they are almost the same. The difference is not that much, but they are more sensitive to the price movements because, as I told you before, the moving averages, all of them, any type of them, they are lagging indicators. It means the price first must form and then they are going, it means the price, a candle must close and then it's going to give you the data. it means that we need something to be fast in order to not to lose a trade. If I have an indicator which, I'm gonna wait for a signal, okay, I'm sitting here and waiting for the price to go up, and then suddenly it goes up like a sharp movement and I lose the trade, and it makes me really angry because I was waiting for a signal which was given to me too late. In the case of EMA, we are going to use them mostly for our trading. It is, I told you, as same as the M.A.C.D, but more sensitive to the price movement. But how do they really work? We need to know all about crossovers. In the classic trading era, we had a time that people used to trade only with EMAs. So let me bring another EMA to the chart. How to do that? You can just simply search for EMA and move another one. In the free version of TradingView platform, you can add up to 3 indicators, not more than that. And we don't need really more of those. And later on, I can show you some hacks which you can do in order to have more indicators. But in the end of this course, I will let you know that the more simple the chart is, the more effective it's going to be in your trading career. I have seen lots of people, you can just go to the YouTube or Google them. They have a chart that everything is on the chart beside the price, which are the candles. This is a disaster. We don't want that. We want to avoid that. But first, we need to get familiar with our toolkit. Let me change the period of one of them to 20. Why 20? We have some fixed over time. People came up with some fixed strategies for the period of EMAs or MAs, which I'm going to write them down for you here. So 9 period, then 18 period, 20 period, T period, 100 period, 200 period. These are the most used ones in trading. But in order to tell you the old-fashioned type of trading was like this. People used to wait for a cross. Let me just remove the candles for a moment. Like here, occurring here. Let me change the colors for the shorter, or let's say smaller EMA to, you can go to the styles just like that, change the color, the thickness. It is really simple. I talked about this previously in another session, but let's change the color to orange. And for the bigger EMA or the longer period EMA, I'm gonna change only the thickness so you can see them easily. So this cross here, if smaller EMA breaks the higher EMA, so in this case, the 9 EMA breaks up from bottom to top, the 20 EMA, we call this, in this case, the golden cross. You really don't need to remember these names because in the end of the day, they do not affect your income, okay? But it doesn't matter what you call them. But I just need you to know, if you hear it somewhere, don't panic or don't be surprised. So golden cross. People wait for a candle to close above the bigger EMA, the 20 EMA as the main EMA, and then let for a cross here. So let me bring back the chart here. So the cross happened, and then this candle closed above the bigger EMA. So they went for a long trade here, put the stop loss somewhere around here. It depends on the trading strategy, and then we're going to talk about this a lot later on. We have a lot to talk about, but if you just take a look at here, you can see we have lots of things. But before going for the rest of the trade, if you can see, here is a support area which we talked previously. If you haven't watched those videos, highly recommend it. Again, go watch them first, because they're mandatory to be watched. The price went down, had a reaction to this point, and then from here it shoots up. Let's look for other trading signals. So we have lots of candles telling us that the price tends to go up. See, this one is here, an engulfing candle. Of course, this candle here itself, it is a beautiful hammer. And then we have another signals, another engulfing here. We have another engulfing here. We have inverted hammer here. So lots of signals. So this is another confirmation which we can combine to be more sure of a trading decision and make it informed. When the classic trading style says you can come out of this trade, we wait wait for another cross, or some people waited for the first candle to close below the main EMA, or in this case it is the 20 EMA. So there has been lots of ideas, but I'm not using them. You are not supposed to trade like this, but I want you only to know lots of people used to trade like this, somewhere around, coming out of the trade somewhere around here. So as you can see, it was a resistance level here. And it was a beautiful shooting star happened here. Bearish spinning top, engulfing. Let me change the color here, not to confuse you. And it was a beautiful trade. Then we can see another good trade here. We had this cross here. Let me remove the price. This cross is exactly opposite of this cross. So it was a golden cross for a bullish market. For a bearish market, when the price tends to reverse, we call it a death cross. So let me just point out that like this. And it's a death cross. It means that the price is about to die. It means it's about to go down. I don't know how they came up with these names, but it is not really important. Here, at this cross, at this candle, we could take another short trade here, put our stop loss here, and wait for the price again to cross over. So it was a crossover here. As you can see, it is a really nice example of the fact that it was not although it was with some profit, but you cannot make trading decisions like this. In this case, the amount of your risk which you took was a lot more than your profit. So if you want to trade like this, it doesn't really work. Only use these for entry points, not only using these, we are only using these for confirmations. So in this case, we could just enter the trade, but how to go further with the trade, whether it's gonna go forward or not, we're gonna learn that in the future. But what you really need is that these can really give us good and strong signals in order to make some informed trading decisions. Moving averages can be used in various ways to help traders identify trends, support and resistance levels, and potential entry and exit points. For example, when the price of an asset is trading above its moving average, it is considered to be in an uptrend. On the other hand, when the price is trading below its moving average, it is considered to be in a downtrend. So due to the fact that we have always to be friend with the trend and do not go against it, in more simple words, again, if the price is above moving average and it's in an uptrend, or let's say in a bullish market, so we're only looking for some trigger points to enter a long trade. And while the price is going beneath it, underneath the EMA or MA or any type of moving average that we're going to use in the future in our trading strategy, when the price goes below it, so it means it's a bear market, it's in a downtrend, so we're only looking for some trigger points. What are the trigger points? We're going to combine our knowledge with the previous sessions, with candlesticks, with everything that we gathered around. We're going to have summary sessions to find them out, don't worry. But we're going to look out for those trigger points, trigger moments, those golden points to enter a trade, now this time for a short trade in the case of the price underneath the moving average. Well, now it's time for that hack which I promised you to teach you. It is true that I told you that you cannot use more than 3 indicators on TradingView platform in the free version, but in some cases you can. In this case, in the case of moving averages, you can. I really like this one because, especially when I want to use a strategy in sometimes of the market, some types of trading, and I need more than 3 indicators, and I don't want to buy the package and pay for it. So how to do that? You can just simply come here to the indicators section and type in 10 in 1. And the first one, which pops up, this one written by someone who is name is Himanshu, and you can make it favorite, click on it, and then when you go to the setting, you can see you can have various numbers of MAs, whether it's RMA, SMA, EMA, WMA, HMA, VWMA. We only in this case need EMA. It is a good time to make some examples though. Let me put 3 EMAs. Let's put 5. All those numbers which I told you, all the length of the EMAs. So put one on 9, the other one on 20, the other one on 50, one on 100, another one on 200. And the colors, let me change them all to black. And the first one, let's make it gray. Any individual. But what I really want to do here, so if you click here, you can just change the transparency and everything. You can see that they are all EMAs with different lengths. Do I need to use all of them? Of course not. I just wanted to show you how do they work. They are all EMAs in different lengths. 9 EMA, calculating 9 previous closes. 20, just like 9, and the story goes on. We really don't need to use all of them. There is a strategy which we can use, the crossovers, which I told you beforehand. But in this case, I just only wanted to show you this hack, which may become handy sometimes. But let me remove all of them and just stick to 200 EMA, just like that. Bring the candlesticks back. And you remember when I was talking about the dynamic support and resistance levels? Okay, here it is. In this case, it is just like the rules are the same as the static support and resistance. So we have a resistance level or some resistance level, but they are moving. It's not always like, it is not just always be here. So they are moving down in an angle like this, as you can see. And we had certain points which the price tend to go back from, and this is another trading strategy. I don't want to dive more into it because we have to know lots of other things, then come up with the strategies. But in this case, we see that the price went below the 200 EMA, so we consider 200 EMA as our main trend finder. So if the price is below it, it means it's a bear market, and we only look for triggers to go short. So here the price is below it. How many times it hit it? See, one rejection here, one rejection here, another rejection here. Then it could manage to break it through and go. And here now we could look up for long trades. So one long trade here, another long trade here. And you can see, you can find some chart patterns, candlestick patterns too. Here it broke this 200 EMA, this dynamic resistance level. So it's a resistance level. And then when the price breaks it, it becomes the support level, just like a static support and resistance. The rules are the same. So it's 3 white soldiers. Here, another opportunity. We have one bullish spinning top, and then it changed into beautiful engulfing, and in the meantime it's 3 white soldiers. Here we have, you can see beautifully, we have 3 black crows. We have this beautiful bearish spinning top here, and you can find lots of examples. You can see this doji. Lots of confirmations are here for you to just take a trade. But long story short, let's just know the rules for now. If the price is below our main trend finder, which is 200 EMA in the most cases, we only go for short trades. We do not go long because, again, trend is our friend. We do not go against it. So if the trend is going down, we are going down with it and going short. If the trend tends to go up, so okay, we go up with it. But this is not only enough for trading, believe me, you cannot trade like that. And another rule of thumb is that the 200 EMA, or let's say this dynamic support and resistance level, in this case when the price is below it, so it's a resistance level. When the price goes above it, it becomes a support level. So this dynamic resistance level is working like a magnet. When the price is going far from it, it's working like a magnet and trying to bring the price back to itself. And it worked here too. See, the price went up and it took it down to itself. And when the price goes really close to it, it becomes like a rejection point because it's a resistance area and it's trying to reject the price. Up to the moment that it's going to be broken or breached, which we're going to talk a lot later on. But I wanted you to know this is another trading strategy that lots of people are using or used to use in previous eras of trading, but it's not working nowadays because the Market has changed. It's not just like before. See, for example, in this case, if you wanted to take trades, okay, going above it, go long, okay, hit your stop loss here, and you would have lost lots of money within this trading range here if you wanted to trade like that. If the price goes below the 200 EMA, so you go short, it doesn't hit your target. Then you want to go long, it doesn't hit your target again, and you have lost lots of money here if you only wanted to use this trading strategy. However, it is important to note that moving averages are lagging indicators. This means that they are based on historical price and may not be able to predict future price movements accurately. Therefore, traders should use moving averages in combination with other technical indicators and market analysis tools to make informed trading decisions. This is the reason I told you before, we cannot use only support and resistance levels. We cannot use only chart patterns or even candlestick patterns or even a specific indicator. We have to combine all the data and collect the data, and in the end, we come up with the decision whether we want to take a trade or not.
Keep in mind that moving averages are only one tool in a trader's toolkit, or let's get back to the example of a carpenter, that this is only one of the tools that you have. It is important to understand the market, have a trading plan, and of course coming up with a really good risk management system, which I'm going to help you out in the upcoming sessions during this course, how to become a successful trader. Whatever session that I make for you, please just combine it with the previous sessions and add it up to previous sessions. And of course I'm going to have summary sessions just like previous session. If you haven't checked that, go check it out too. Just combine them together, practice, and always feel free to reach me out in the comments below and ask me whatever question pops into your mind. I would be really happy to answer you. If you really like the content that I'm making for you, please hit the like button and subscribe to my channel if you haven't done it yet, and share my videos with your other friends who are keen to know all about trading, about this messy world of trading, which I'm trying to make it as easy as possible, and I'm here to do that for you guys. Thank you for watching. See you in the next one. Each session passes and you are more and more closer to become a successful and of course professional trader. During this journey, how to choose the right tools in the right place and right time in order to become artist in the field of trading. Don't get me wrong when I always telling you do this, because all the sessions are coming right after each other and they are mandatory to be watched before you watch the next session. If you haven't watched my previous videos, this video is not for you, so please go check them out first. Previous sessions we talked about different stuff like support and resistance levels, chart patterns, candlestick patterns, and we talked a lot about them. Then we had a summary session. Previous session was about the first session was of course about the technical indicators, and we talked about moving averages. This session I want to talk about relative strength index, or RSI. It is of course another really powerful technical analysis indicator which the traders are using it in order to follow the price movements. RSI, or as the full name represents, relative strength index, is used to measure the securities movement and price action. It was developed by J. Wallace Wilder back in 1978 and has become one of the most popular trading indicators used by traders. As for today, RSI oscillates between 0 to 100 level, and it is calculated based on gains and losses of a specific stock, currency, or asset over a given time.
Well, first let's find the RSI, the easiest part. Simply, we have to go to this section, the indicator section, but before that, if you don't know how to work with TradingView platform and how does it work, Previously, I made a complete dedicated session for it, a complete video for it. Go check it out. There's a link down in the description. So we're going to the indicators section and we simply write down RSI. And it's here, Relative Strength Index. As you can see, just like the previous session, like moving averages, there are tons of them out there, written by different programmers / traders just like us. There are a couple of them here, but what we need is this one, RSI, Relative Strength Index. Let's make it a favorite and click on it. Bring it on our chart. You can see it's coming down here. For a moment, I want to make it maximized as a maximized pane like this, and let's make it full screen and go to the settings and talk more about it. The RSI calculation involves taking the average gains and losses of the stock, security, or an asset over a set period of time. The default time period used by most traders, including I myself, is 14 candles. The formula for calculating RSI is just like this. Let me write it down for you. Okay, so this is the formula, and where RS stands for the average gain of the stock, security, or an asset over the specified period divided by the average loss of the stock, security, or asset over the same period.
So what does an RSI really tells us? It tells us whether an asset or a stock, or let's say a security, is overbought or oversold. A stock, security, or asset is considered overbought when it is above level of 70, indicating that it is close to the moment that it may has a correction. And by correction, I mean it may reverse. Conversely, a stock, security, or asset is considered oversold when it is beneath the level of 30. Somehow we can say when we are close to support and resistance levels, it can indicate for us that and giving us that signal, okay, I am oversold or overbought. So when we are reaching an overbought area, it means we are close to a resistance level. And when we are close to a support level, we are going for oversold area below the level of 30. Let's go to the chart and see how it works.
Let's go to the setting again. You can here change the colors. I really don't like the default colors. I highly recommend to leave all the settings, as I told you before for the beginning, leave all the settings to their defaults, but sometimes you can just change the colors in the beginning. Do not touch lots of things. So you can change the colors and make them a little bit more visible to your eyes. So as I told you before, the RSI oscillates in between the level of 0 to 100. Our key levels are level 30 here and level 70 here. So whenever the price is approaching this area and going above it, I mean the 70 zone and 30 zone, when it's going above 70 zone, it means it is overbought and we may have a reversal of the price. It means somehow it's close to a rejection zone, let's say resistance zone. The opposite is the same. When the price is going beneath this 30 level, we can expect that the price is close to support level, the key level. It may reverse from there. Let's bring the candles up and see if it is working exactly like this or not. In this case, we had support level, which the price had a reaction to, and you can see there was a beautiful hammer happened here, another hammer here. We have some reversal signals, and in here the RSI is telling us, okay, I am oversold. Let me change the color to green in order to make it as a support area. And then sometimes it is not always working like that, so you need to combine it with the other things. But sometimes, for example, in this case here, you can see it is overbought, and we are expecting for the price to go down, but it didn't go down. It just went down a little bit. It was a correction, and then the price went up and up and up. In order to know if they are valid signals or not, there are tons of things that we have to check, but due to the fact this is a dedicated session to only RSI, I want to only talk about RSI. Later on when I'm going to finish the most popular technical analysis indicators, then I will have some summary sections and talking about how we can combine these ideas and techniques to come up with some strategies. But just talking about RSI, so you you cannot only rely on this overbought or oversold territories. These are only for having some confirmation. How can we avoid false signals? There is a way, there is more reliable technique which we can combine with the other data that we have from previous sessions, like correctly finding the support and resistance areas. So in this case, you have to go watch that video if you haven't watched that yet, but I don't want to get into that now because that's a complete session. I made a dedicated video for that, but here we have a resistance level and we can see that the price made a higher high. It was one high, it is a higher high. And then when you take a look at here, so let me just mark it like this. When you look down here at RSI, you can see a higher low. This is the reason that we call it a divergence, a negative divergence, and vice versa. A positive divergence is happening on a support level when the price tends to go up. But here in this case, when you go and zoom on it, you can see, yeah, we have lots of good signals, like a strong engulfing here, plus our divergence, plus our resistance level, and plus lots of other things which we can rely on as strong signals that the price tends to go down. And yeah, it went down to our support level. Let me change the color to green. It was a pretty nice trade. If we took this trade like this, it was, oh my god, 32% with the leverage of 10x. If you don't know what all this means, this is the reason that I'm asking you always in the beginning of each session, go watch the previous videos one by one, because you have to know all the things. All these sessions are connected like chains to each other. It was a pretty nice trade. Let me find another example. So here's a really nice example for a positive divergence in RSI. So this is our support level. And then you can see that the price made a lower low like this. So this is one low, another low, a lower low. Let me mark that like this. But the divergence happened here in RSI, and the RSI made a higher low. So it means that the name is telling us relative strength index. It means that the sellers are losing their strength and the buyers are coming in. And what is our trigger point here to enter a really nice trade? This beautiful engulfing, and in the same time, three white soldiers. One strong double candlestick pattern and one strong triple candlestick pattern is telling us that, hey, I'm going up, and yeah, you can take that trade. And it was our resistance level up here. And if I just change the color to red, so if we took this trade here, our stop loss here and going all the way up to here, it was like, oh my god, almost 40% of profit with leverage of 10x. And then exactly right after that, we had another beautiful signal which told us that the price tends to go down. Here is a higher high. Let me mark it like this. But in the RSI, we have a higher low, another divergence, and boom, engulfing. Beautiful, strong engulfing happened here. And before that, we have shooting star here. So we have this short trade here, stop loss here, and target point here. Did it hit our target? Yes, it did. It took some time, but it did. It did beautifully in this case, and it was a nice trade. Another 31% with 10x leverage, and oh my god, if you made these two trades, it was like almost 70% of profit in matter of hours, and it is crazy. But there is a problem with this technique. So what the problem is, if you take a look at here, we have two examples of two divergences happened. If you look at the RSI, there are two RSIs. In this technique, we can use two RSIs in the same time, but I don't want to get into that. It is just an example for the divergence did happen, but it didn't work. Why? Because again, like chart patterns, which we talked about previously, like candlestick patterns, like any other trading indicator or signal that we can get from the chart, they must happen on certain areas and points which are supply and demand zones or support or resistance areas. So if you do not determine and find them correctly, the signals that you find, they mean nothing, and they can make you lose a lot of money. So in this case here, we had, let me zoom in, we had beautiful divergence, so lower low, lower low, lower low, but here the RSI had 3 higher lows. We could wait for a really strong signal like an engulfing here, and the engulfing happened, so we could enter a trade here and take the profit. But here, as you can see, if let's imagine we didn't take this trade, wanted to take this trade, or we entered the market and the market was at this certain level, and we could see that higher lows happen, and here we have a beautiful divergence in RSI, but the price didn't go down. Why? Because it is not happening on a key level. It is not happening on supply or demand zones. In this case, because the price is going up and we are expecting for the price to bounce off and coming down, so it is not true resistance level. As you can read here, where there was a reversal like here, often there was a divergence, but a divergence like here does not cause a reversal. It just signals one might fall. So how can we just make sure that it's gonna happen? First things first, you have to determine support and resistance areas first. With any trading strategy that you want to choose in the future, which I'm gonna teach like tons of them to you, and it is you who's gonna choose which one is the best for you, and I'm gonna even help you with that too. But the first thing is like driving with your car. You're getting in, the first thing you're gonna do is fasten your seatbelts. So we have to find these, and in the upcoming sessions I'm going to combine these support and resistance levels with RSI, with moving averages, with different other trading indicators, and we're going to come up with really strong techniques. But here now you have to know that you cannot trade only with support and resistance areas, nor with only the candlestick patterns, chart patterns, or even a single technical analysis indicator. You have to have a perfect combination. Of course, there is not such thing as a perfect combination, but almost perfect combination, which fits that type of the market and that specific pair that you're trading and that specific time period that you're trading in. And it's going to fit you the best, and it's gonna of course serve you the best.
So did you like the video until the moment? If you really like it, please hit the like button. Just like the previous things which I told you, like the chart patterns, candlestick patterns, and even the moving averages, you cannot only rely on RSI as a trading, or let's say single trading tool to take your trades. We have to combine it with other indicators and strategies and bring them all together at once, coming up with several trading strategies for different types of the market in order to make informed trading decisions. So there you have it. In the upcoming sessions, I will talk about the other popular trading indicators. And when I'm done telling all about the popular indicators, we're going to have summary sessions, and we're going to have some almost trading strategies, and coming up with some ideas how we can gather all the knowledge that we've gathered throughout this course up to the moment and combine them with together and see how they work on the real market. And we're going to have some backtests on the market on different assets, different time frames. So don't go anywhere. Watch the videos carefully and take a pen and paper, take notes, and watch them carefully. Watch them as much as you can. One time is not enough. Believe me, watch them 1 time, 2 times, 3 times, 1,000 times, until the moment that you get it. And if you don't get a specific point, or you don't get it at all, just feel free to ask me in the comments below. I would be really happy to answer your questions. If you haven't subscribed to my channel, please do it right now. So you're going to be the first to be informed by turning the notification bell on when I'm uploading a new video. I'm uploading my videos each 2 days, so it's like a series coming up. You don't have to wait for next session so long, so it's going to be really compressed. Please share my videos with your friends who you really think they are keen to know about this messy world of trading, which I'm trying to do my best to make it as easy as a piece of a cake. Thank you for watching. See you in the next one. Another session, another technical analysis indicator. This time Bollinger Bands. Before getting right into it, I hope that you've practiced and understood everything I've told you in the previous sessions. And this session is based on the previous ones. So let's see what is it all about. If you are new to trading, or even if you are trading for a while and you are looking for something to help you out, making your trades more effective, Bollinger Bands is a good place to start. In this video, I'll go over what the Bollinger Bands are and what are the different types of trading that we can make with them. But I have a secret trading strategy for you in the end of the video. Don't go anywhere, watch it until the end, you're gonna be surprised. Bollinger Bands are a technical analysis indicator developed by John Bollinger back in 1980s. They measure the volatility of the market, so it's a volatile based indicator, and it helps the traders to find some good signals for buy or long, sell, or short positions.
When stock's price moves outside the upper or lower Bollinger Band, it is considered overbought or oversold. This can be a sign of a potential trend reversal or continuation of the current trend. However, it's important to keep in mind that Bollinger Bands are just one tool in your trading arsenal and should always be used in conjunction with other indicators and analysis. Now let's go to the chart and see some examples. So let's first find the Bollinger Bands. It's really easy, just like the previous session. Like for RSI or moving averages, we go to the indicators section and simply write down Bollinger Bands or double B. The first one here is Bollinger Bands. We can make it favorite and click on it. I highly recommend to leave it to the default setting, leave it B, so it is how it looks like. How does it really work? So in this case here, for example, you can see when the price went out of the band, it's working like RSI somehow and showing us the overbought zone, and for the bottom of the band is oversold zone. So whenever the price goes above it and then comes back in, it means that the price may reverse, which did here, and when the price is going below it, I mean below the deviation band, and then goes back inside, it goes up. One of the traditional ways to trade with it is just people used to wait for these happening and go short here with the stop loss here and wait. There are two ways. Some people come out of trade just on the mid band, or some people wait for the price to go below the mid band then enter a trade, or just they just wait for the price to go below band here and come out of the trade. But it doesn't really work always. It's a good trading strategy, but if the market is going range, when the market is going up in a trend, for example here, if you wanted to take short trades here, there will all loses. For example, short trade here, this one was a win, but in this case here, if you took a short trade here, we had to wait for the price to go back in. If you wanted to wait for the price to go below the lower band, it never happened. It just hit your stop loss here. Again, it happened here too. Another lose here. So you can lose a lot of money if you just stick to this strategy, and it can make you lose a lot of money, and you come with the idea, oh, this is not a good trading strategy, and it happened here. Later on in this video, I'm going to show you my secret weapon, how to make this strategy work, combining it with other strategies. But this is one of the methods which people use. You can use it, but you have to be aware of these facts. It can really make you lose a lot of money. So how people really use the other ways to trade and use these Bollinger Bands in their trading strategies. One of the ways was the previous way, which I told you, but it has its pros and cons. The other way, which is a really popular method, is to look for a squeeze in the bands. A squeeze occurs when the bands are close together and the stock's price is trading in a narrow range. This can be a sign of an upcoming breakout, and traders will often look for a move outside of the bands as a potential buy or sell signal. Let's go to the chart and see some examples for this one too. Concerning the squeeze trading strategy with Bollinger Bands, if you take a look at here, you can consider these deviation lines as dynamic support and resistance levels, which is causing the price to go down or go up, whatever it is. But when the price is going to squeeze, like here, if I zoom out, just like that, you can see that the price is squeezed within this area. It means that the buyers and sellers, they cannot fight each other and the market is in indecision. But whatever direction is going to break this area, the price is going to bounce off hard that direction. So we can just determine these areas with lines or areas as support and resistance levels, like here, small ones. Or another method is just you can put just a line, a horizontal line here, and you wait for the price to break it either ways, up or down. And then when the price does it with a strong candle like this one here, you can take a long trade. Put your stop loss below this lower line here, or you can just consider these shadows, but don't worry about the place of the stop loss. I will talk about this in the upcoming videos, because we have to talk about that in risk management a lot, where to put this stop loss exactly here, here, or here. We will talk about that, but just for the moment, we just want to see if this trade hit our target. And there are different ways to set the target point, which I'm going to talk about later on, but some people take it for 1 to 1.5 risk to reward ratio. Some people make it on 2. Some people make it trailing a stop loss and go as high as it can go. And there are lots of ways to do that. Let's make another example on the chart. So here's with another example on the chart, and you can see that we had a squeeze here. The price was squeezed really hard in this area. So if we just could put a horizontal line here above this area, and when you want to put it here, where to put it exactly on the line or behind it, you can just go a little bit back, not a lot back, because you cannot rely on these points. You must just check the recent areas and look for some areas that the price had some reactions to it. Like here, for example, we can see some shadows, lots of hits on this area. So we just put it here, and then another line is going to be beneath it. So if I want to put it here, I look at back like here, I see, okay, lots of hits here, so I put it here. When I see the price is going beneath it, I must add some thing here, and that's it. The price must both go beyond the support or resistance lines and the Bollinger Bands deviation line, like here. So if it's going to just be passing one of them, not the other one, it's not considered as a valid signal. So in here, it passed both lines, both the Bollinger Band deviation, lower deviation line, and our support level. So we can just take a short trade here on this candle, put our stop loss behind this line here. Where to put it, I will talk about later on, but we can go for a trade for risk to reward ratio. I haven't talked about the risk to reward ratio, but I just want to tell you how people making these trades. So 1 to 0.5 or 1 to 2, like that. So it was like 2.21, almost 22% of profit with 10x leverage, which is crazy good. And you can just keep these trades like this, and in lower time frames you can see lots of these signals, but I myself found them mostly efficient in 15 and 30 minutes time frame. Now it's time for my secret weapon to tell you how does it work. In order to do that, we need to add one RSI to the chart. So how to do that, we go here, and we had it from the previous sessions. If you want to know what I'm exactly talking about from this moment on, you have to watch my previous videos, especially about support and resistance levels and relative strength index indicator, which I'm going to leave the links above here, and both you can find it even down in the description. So we need relative strength index. I don't add moving average, exponential, or any moving averages, because this mid band, as I told you before, of the Bollinger Bands is the M.A.C.D, and we can rely on that. So let's go to the setting of RSI. What I need to do is to remove the M.A. baseband. We don't need the moving average because we have it on chart, and remove everything about the middle band. and we don't touch any settings here. So next thing which we need to know is determining our support and resistance levels. So if I zoom out a little bit, you can see it was a support level here and it got lost like here and it changed to resistance level, which I talked about this previously. This is the reason that I'm telling you that you have to watch my previous videos, especially about support and resistance levels, which are mandatory for any type of trading to mastering them. So here it was a support level, then it got lost and it became a resistance level. You can see that the price cannot break it anymore. It is our resistance level here. We have to take a look at our Bollinger Bands. So one time broke it, we don't take a trade. Second time broke it, we don't take a trade, but we know that the price just is at a certain key point or key level of resistance. So we must wait for a confirmation signal to enter a trade, a short trade. How to do that? All right, we have a couple of things which is telling us that the price tends to go back down. First, we have RSI divergence, which I talked previously on in RSI session. Watch that video. Higher high in the price, but higher low in RSI. We can wait for the moment that the price goes down. And then we have one engulfing candle here. You can see if I zoom in, the green candle is within the body of the red candle. So the red candle, it's a bearish engulfing. The red candle is covering completely the body of the green candle. But we do not enter the trade yet because we need more confirmation. If you watch my previous video about moving averages, due to the fact that this is a moving average, this middle band, it means that the price is still above it and we are not allowed to take short trades yet. So we have to wait for the price candle close beneath it. The candle closed here. If you take a look at here, you can see it's a beautiful three black crows, which I talked previously in the candlestick patterns, which you have to watch those videos, those 3-4 sessions as well. I'm going to leave the link both down in the description and above here. Now we can be pretty confident because we have lots of signals. The price went above the higher deviation, upper deviation band of the Bollinger Bands 2 times, RSI divergence. Then we had engulfing here. This is our resistance level. And then the price had a strong close below the MA20 line. And it is 3 black crows. So we can be pretty confident that it can be a successful trade. So if we took a trade here, put our stop loss here, and here we have many options. You can go for 1.5 risk to reward ratio. You can go for 1 to 2, or you can just like before, if you are familiar with the support and resistance levels, if you know that if you knew that there was a support level here, how we can know that? So we go back in the market, it was actually here. Almost 1 to 2 is at this key level, support level here. And we could just take a trade like this, and it was, oh my God, 3.61% with the 10x leverage. It was like 36% of profit in only one trade. How much money you want to make? Are you greedy or that's enough for you? Then we can mix it up with our other strategy. Okay, want to squeeze here on this support level. It's a little bit lower than here. So squeeze here, we can boom, be like that. Okay, so our support level here, it broke it here, long trade here, stop loss here, and we had lots of other signals, engulfing, bullish spinning top. You can see there are lots of signals which are telling us that the price tends to go up. So if we extend our resistance level here, we go up here, and another trade, boom, like that. 3.81%. So if you only want to use Bollinger Bands, it's not really going to work out, and you're going to lose money. This is the reason that I'm telling you, maybe you can go to YouTube, or you can buy a book. You can find lots of classic trading strategies, but they are not working as for today. Maybe some couple of years from now, These methods are going to be corny. They're not going to work out. But as for today, this is one of the most efficient ways to trade on the market. And I myself, I'm using this sometimes, not mostly, but sometimes. And I will talk about that later on. But believe me, you are not ready yet to go to the market and trade for yourself. But keep it in mind, as a strong strategy, you can mix it up with support and resistance levels, with RSI divergences, and it's going to be really strong trading strategy. That's for it today. And if you have any questions, just feel free to ask me down in the comments. But practice, 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 and never get tired of practicing. Watch these videos as much as you can. Come back again, watch it again. Believe me, when you're gonna watch the market and try to practice for yourself, and whenever you come back and watch the video again, you realize that, oh my God, there is something new in it. And I didn't know that. You think you know, but you don't, because you are a rookie. If you're already trading and you're here to just solve some issues, okay, that's enough. But if you're a rookie and you're a beginner, you really need to watch these videos a lot.
It is important to keep in mind, although I've told you strong strategy how to trade with Bollinger Band, but it is not a crystal ball. And you cannot only use it in isolation. Later on, when we complete all the trading indicators, of course I cannot talk about all of them, about the most popular ones, and we get to know different types of the market, the volatility of the market, how we can make some successful trades. And during the course, and especially when the course is going to be done and it's going to be finished, I'm going to record a complete playlist, and we're going to come up with different trading strategies, especially Bollinger Bands, and coming up with vast amount of trading strategies. It is you who is going to choose one or some of them for different types of the market and trade with them. And in the end of the day, you, me, everyone out there, we are doing a job. Doesn't matter if it is trading, freelancing, going to a simple job out there. If you're a doctor, you're a pilot, you're an astronaut, in the end of the day, we want money. And I am here to help you how to make money conservatively, continuously in the financial markets. So, did you like what I've told you? If you really like it, hit the like button, share my videos with your friends, and if you haven't subscribed to my channel, subscribe now and turn the notification bell on so you're going to be the one to be informed when I'm going to upload a new video, which I'm doing on a daily basis. Thank you for watching. See you in the next one. Welcome to this video about moving average, convergence, divergence, or well known as M.A.C.D. Another strong and popular and most used technical analysis indicator used by vast amount of traders out there. In this video, we'll explore the M.A.C.D, how it's calculated, and how can we use it in our technical analysis. I will also go through some examples to make you understand this trading indicator better. But in the end of it, just like previous sessions, I'm going to show you a secret way, a better way to combine it. I don't want to tell you go trade with it. This session is only about getting to know the indicator. But later on, we're going to come up with different types of trading strategies. We're going to talk about them as much as we can. We're going to have answers, questions, practices, and we're going to have a lot of fun. But just like before, because this is a series of episodes coming up on daily basis, and this is an educational trading course, if you are new to trading, you have to watch my previous videos before you watch this one. And if you already are familiar with trading and you just want to get some answers, get to know a specific subject, Okay, that's it.
What M.A.C.D really is? M.A.C.D is a popular technical analysis indicator that helps traders identify trends and potential changes in the trend direction. It is calculated by subtracting a longer-term moving average from a shorter-term moving average. So if you don't know what moving averages are, you have to check my previous videos, which I'm going to leave the link down in the description. The result is then plotted on a chart as a line that oscillates above and below a zero line. Well, we need to know how M.A.C.D is calculated. The M.A.C.D is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. A 9-period EMA of the M.A.C.D line is then plotted as a signal line. The M.A.C.D histogram is the difference between the M.A.C.D and signal line. Now let's see how the M.A.C.D is used in technical analysis by lots of people. One of the primary uses of M.A.C.D in technical analysis is to identify trends and potential trend reversals. When the M.A.C.D line crosses above the signal line, it is considered bullish. Conversely, when the M.A.C.D line crosses below the signal line, it is considered a bearish signal. Traders may also use the M.A.C.D histogram to identify momentum shifts in the market. Let's go to the chart and see some examples. Well, if you watched my previous videos, you know how to bring a technical indicator up on the chart. So just like before, we go to this section here, indicators, metrics, and strategies, I will simply write down M.A.C.D, and it's here, this one, moving average, convergence, divergence. We can make it favorite and click on it. It's gonna pop up down below here. Let's zoom in and see. Well, the classic way that people used to trade with this indicator was that they waited for the price to change direction, and it had always two requirements. First, the blue line must cross the orange line down. So what are those? Those are M.A.C.D line and signal line. The M.A.C.D line, the blue line, you can change it to any color. This is the default settings. I don't want to touch it. I don't want to change it. So the blue line must cross the orange line down in order to take a short trade. Then you must check down below and the histogram must be in red. It means a change in the direction. Let me mark this area, this one here, this cross here. Go to the chart and see, yes, it was a change of direction in price, and the price couldn't manage to go upper than this. And if we just take a look at some other examples, another time it happened here. So if it, the price went up here, went up, and then it reached this point here, and we had a cross of the M.A.C.D line with the signal line, and then we had one histogram in red. And there is also a third option to get the confirmation that people used to trade with it. You must see a red candle, for example, after that, like this one here, and then enter a short trade. But as you can see, if you wanted to take a short trade in this case here, it wouldn't work out because you wanted to take your stop loss here, and then it would have taken your stop loss and then went down. Or another one here. So if you wanted to take a short trade here after the cross of the M.A.C.D with signal line, and you have a red histogram and you wait for a red candle here, and it was engulfing, but it didn't work out, and it didn't go down, and it had our stop loss. So two losses after each other. How to avoid that, really? How can we avoid that? So first, we must be familiar with support and resistance areas, which I talked previously completely, and I told you everything about them. So how can we really trade with them? We have to combine it with the other data that we have from previous sessions, like support and resistance levels, like these ones here, which I drew them from before. How to do that, you have to watch my previous videos. I'm going to leave a link above here, and you can both find it down in the description. Of course, we have a cross here, but this is not enough. We have to check our resistance level. So we have a resistance level. Yeah, we can be ready for the price to reverse. Then we come here and see beautiful shooting star, and then engulfing 3 shooting stars after each other, right after each other. Then one engulfing happened here. So this red candle, big red candle, is engulfing the previous candle, which is this one, which was itself also a shooting star. And then we can see right after that, we are still waiting here because previously I told you we cannot even only trade with candlesticks. So we wait for more confirmation. So we can see 3 black crows here, really good, really nice. Then again 3 black crows, but this before these 3 black crows, we have a cross in the M.A.C.D with signal line. But the candle was still green and the histogram just turned to red. So we wait for the red candle, this one, another engulfing, and we say, yes, now I can enter a trade. So I enter a trade with the close of this candle. I put my stop loss here and I go down where all the way to support level. And did it hit our target? Let's see if it did. Yes, it did beautifully. And how much profit was it? 5.83%. With 10x leverage, it was like 58, almost 60 to 60% of profit, which is a big wow. But the classic way to trade with the M.A.C.D, people used to wait for a cross happens here, then go short and wait for another cross like here and come out of it. But it was here. So instead of 60%, you would have only 7%. 7%, 60%, or 58%. It is not even close. If you want to come up with really good strategies, and of course you must have good money management, risk management system, but if you combine it with the other data that you have from before and you mix it up, then I'm gonna show you how you can build up your own trading strategy. I'm gonna show you a way that you can build up your own trading strategy. So don't worry, you shouldn't trade with the thing that I'm telling you. Like you can see tons of these videos. You can go to the YouTube and search for yourself and see people are promoting their videos like, come here, watch my video, you can earn like thousands of percentages of profit. But this is not true. I think you are going to be a pro at the moment, which you can coming up with your own strategies. You can coming up with your own plan A, B, C, D. So it's not going to be what I tell you, and I don't want to tell you you have to do this, you have to do that. I'm just going to tell you the don'ts, and I'm going to leave the do's to you, because by the end of this course, you're going to be a pro and you can decide for yourself. Let's see another example on the chart. So a little bit further back here, we had another beautiful cross happened here, histogram green. Then we zoom in and we see, okay, we had a cross of the M.A.C.D with signal line, histogram in green, candle in green. So before that we had one hammer. Now we have one green candle, big candle engulfing that. Then we have this, as you can see, this beautiful 3 white soldiers. And if you take more look here, we have one double bottom here. You don't know what a double bottom is? Check my previous videos. Check the link above here. So you have lots of signals which are telling you you're good to go. If we had one long trade here, just by the close of this green candle after this cross of the M.A.C.D. This is the reason I'm telling you these are only confirmation signals. You have to mix them up with each other. And then we go all the way to resistance level. Did it hit our target? Yes, it did, of course. So 58% was here. Here it was another 6.3% with 10x leverage, 63%. Just go fetch your calculator. More than 100% profit. Name a job that you can earn that money in a good way, of course. Not doing fraud or con. So if you can name any job, I'm going to give a prize. Just leave your ideas down in the comments below. I would be surprised to see your ideas. Maybe there is a better job. I can do that too. Of course, just like the previous technical analysis indicators, we cannot only use these techniques to trade. We have to
use them in conjunction with the other methods that we've learned before, which I'm going to talk a lot later on when we want to come up with different trading strategies, although I pointed out some of them throughout the course. But we have to, I repeat, we have to come up with really strong money management, risk management system. It is not, the trading is not only about trading strategy. Trading strategy is only one of the tools for you as a carpenter to make your masterpiece, that Trojan horse of yours, to send it into the market and say, oh, I'm here, I want to make a lot of money. So did you like this video too? If you really do, please hit the like button, subscribe to my channel if you haven't yet, and share my videos with your friends so they're gonna take the benefit out of this free trading course too. If you have any questions, if you have any ideas, just feel free to tell me down in the comments. I would be really happy to hear your ideas, help you with your questions. That would be my pleasure. Thank you so very much. See you in the next one. Hello there. Do you like my new look? I like it. I decided to change a little bit of my look, my appearance. Instead of just sitting here in front of you guys and talking, I wanted to make a change. So welcome to this video on stochastic oscillator. In this video, we will cover everything you need to know about the stochastic indicator, or let's say oscillator, because it oscillates, including what is it, how it works, and how you can use it to improve your trading strategy. The stochastic indicator is a technical analysis tool that is used to measure the momentum of a particular asset or security. It was developed by George Lane in the 1950s and has become a popular tool among traders ever since. The stochastic indicator works by comparing the closing price of an asset to its price range over a set period of time. The indicator then calculates the percentage of the price range that the closing price falls within. The calculation results in a number between 0 and 100, which is used to determine whether the asset is overbought or oversold. The stochastic indicator is made up of two lines, the K% line and the D% line. The K% line is the faster of the two lines, and it is calculated using the following formula. The D% line is the slower of the two lines and is calculated by taking a 3-period simple moving average of the K% line. The result in a line that is smoother and less volatile than the K% line. When the K% line crosses above the D% line, it is considered a bullish signal, and when the K% line crosses below the D% line, it is considered a bearish signal. Now let's go to the chart and see what is it all about. Well, just like my previous suggestions, if you haven't watched my previous videos about the other trading indicators or the previous videos before that, please go check them out first, because knowing the definition of RSI indicator, moving averages, M.A.C.D indicator, they're going to help you a lot better to understand the concept of this very indicator, which is the stochastic. Just like before, we're going to click here on the indicator part and we simply write down a stochastic, this one here. We have lots of them, and you can see here a stochastic RSI, which I'm going to talk about later on. So stick with me until the end of the video. We're going to talk about a lot about these two. But first, with the stochastic, we make it favorite, click on it, and it's gonna pop down here. As you can see, let me bring it up. So just like RSI or even like M.A.C.D, it is again the same. We have one line down here, one horizontal line above here. So when the price goes above it, in some cases it's at the level 70 and 30 in some indicators. In some indicators in that 20 and 80. It depends on the written algorithm and the programming. By the default setting is this, and when the price goes above it, it means that it became overbought, and when it goes below it, it means it become oversold. So we can just trade like this. Let me mark this area here. For example, here is the price. This area, it was overbought. Let's bring the chart up.
And could we just go for a sell trade here? No, we can't. Sometimes it works, sometimes it doesn't. In some cases, for example, here it was an oversold, and if you entered a trade here, it was a win. And where to put the target point, it is not for this sessions. We only want to get to know the trading indicator. Later on, we're going to talk about money management, risk management, and we're going to get to know where to put this. But some cases like this one, if you wanted to take a short trade here at this particular moment, here and waiting for a red candle, let me zoom in. If I wanted to take a trade here, so we would probably look back on the chart and see, okay, here was some point, so I'm going to put my stop loss here, but it would have taken my stop loss. So it is not that much reliable. The other way to trade with it is just like the RSI, waiting for divergences, where you wait for the divergence in comparison with the price and the stochastic indicator. We have a beautiful case, for example, here, as you can see. So this is one high and this is another high, the second high. So if I just put a line here, then we look down here, it's a higher low. So this is divergence, and we can rely on it as a potential signal and go for a short trade. But you have to combine it with support and resistance areas. If you don't know how to, you have to go check my previous videos. I'm gonna leave a link both above here and down in the description. But if you just combine them and you know how to work with them, it's gonna be perfect. You have to know where are the key levels, where are the support and resistance areas to make your trades more efficient. What I really want to get into is to use another indicator. So let me delete everything on chart and add another indicator here. So we have relative strength index on the chart. Favorite it and clicking on it. Let me change just the color quickly. Just like before, if you don't know what to change, how does it work, go check the video about it too. So you can see that they both oscillate so similarly. And so what is the point to use one of them or the other one? What happens if we just mix them up with each other? Yeah, we can mix them up, of course, or just have them both on the chart. But remember, I've mentioned this previously. If you want to use the free version of TradingView platform, you only are allowed to use 3 indicators on the chart simultaneously. So if you want to do that, you have to minimize the amount of indicators that you want to use. Later on, I'm going to tell you why we need to combine some of them. So there is a really good way to do that. Let me just clean up everything and search for stochastic again, but this time I'm going to choose a stochastic RSI. Let me make it favorite, click on it, bring it on a chart. So this is by default a mixture of both the RSI, relative strength index, and the stochastic. So now if you're gonna just bring up, this is the way, if I want to use this trading as a strategy, this indicator as a strategy, I'm gonna add one EMA to the chart. My preferred one is EMA with a length of 20, and then I'm gonna determine my support and resistance levels. This is the support area down here in green, and this is the resistance area. And then this is a beautiful head and shoulders here. We have lots of confirmations telling us, okay, the price tend to go down, but the neckline of this head and shoulders a little bit is angled. Perfect. We have lots of signals telling us, okay, the price is about to go down. And if I just remove this head and shoulders, we even have, if we're gonna be more precise, we have one double top here too. So but these are just confirmations. We should have taken a trade long before seeing this head and shoulders. If you see it right away, so it's a good signal, you can enter a trade and get your confirmations. But due to the law of the EMAs, we wait for the price to go below it, and have a candle close below it. In this case here, it's a mixture of both the price going below the 20 EMA and it is a completed double top. So we know that the price is about to go down because it's on a certain key level point. It's a resistance level. How to enter a trade before that? We have to check the stochastic RSI and we see, yeah, we had a cross down. If you just look at here, you can't see a divergence, but if you a little bit zoom back, you can see that it was one high here, higher high here. I'm gonna mark it just like that, but down below, exactly at this certain level here, we have a higher low. It's not always that beautiful, but it's a higher low. So this is a beautiful, beautiful divergence happen here. So you have lots of signals telling you the price is about to go down. Then we're gonna mix it up with our knowledge about the candlesticks. So we can see one beautiful shooting star here. We have one bearish engulfing here, but we wait for the price for the candle close, the last confirmation to be closed below the 20 EMA. Then we can enter a trade right away, put our stop loss here and go all the way down to our support level. And it was a beautiful trade, 1.40% of profit with 10x leverage. It was like 14% of profit in no time. And it is crazy good, crazy good. And you can just keep going like that, go for a long trade and go practice. By far, you know how to bring up a chart, how to bring up your trading indicators, how to mix them, because I've told you everything about them in the previous sessions. Practice as much as you can, test them on different time frames, different assets. If you have any questions or if you are struggling with a certain thing which is hurting your mind and you cannot come up with an answer, just let me know. Feel free to ask me down in the comments.
In conclusion, the stochastic indicator is a popular technical analysis tool that can help traders identify potential entry and exit points. It works by measuring the momentum of an asset and comparing it to its price range over a set period of time. Traders can use a stochastic indicator to identify oversold or overbought conditions, look for divergences, and confirm signals from other technical analysis tools. However, traders should also be aware of the limitations of the stochastic indicator, or let's say oscillator, and use it in conjunction with other tools to confirm signals. So, did you like what I've told you until the moment? Did you like this video too? Did you like the previous ones? I don't know. If you really like it, leave your opinion in the comments below. Help me out to make better contents for you. If you want to know about a specific thing, or if you think the things that I'm telling you are not enough, just let me know. I would be really happy to make myself better to help you become better. And if you really like my videos, share it with your friends. Subscribe to my channel if you haven't done it yet. That would make me really happy. Thank you for watching. See you in the next one. Welcome to one of the most powerful and popular trading tools, let's say indicators out there, the Ichimoku Cloud. But a quick disclaimer, just right before getting into it, I must tell you guys that because of two reasons, you are not allowed to trade with it or any other strategies or methods I've told you before. First, because there is no such thing as the perfect trading strategy, because if there wasn't these crazy amount numbers of trading strategies, indicators out there, and all the people around the world. I mean, by people, I mean the traders were millionaires, billionaires. So there is no such thing as that. And later on during the course, especially when I want to talk about the money management, risk management systems, we're going to determine and understand what is the reason for that. The second reason is whether you are a beginner or you are someone who is already into trading, but you're kind of lost, you must finish my course. And it is not finished yet. So we have to go step by step by each other. Then by the end of the course, I will tell you, I will teach you, I will show you how to come up with your own trading strategy. Because a trading strategy is based on many factors. First, your personality. If you are a patient person or you are impatient, so we have to solve and get into that a little bit. This is the time frame that you want to trade in, how much time you have, how much effort you want to put. Then the type of market you want to trade in, whether it is crypto, it is stocks, forex, commodities, etc. And there are lots of factors which you have to come up with. And then we have to have 2, 3, 4, couple of, let's say that three is a good number for different types of the market, whether it's a volatile market or it is indecision or whatever market it is. We gotta decide. We have at least three trading strategies and setups for 3 different types of the market, and be ready for any kind of weather, just like this one, which is rainy out there. And if I want to go out, I must go with an umbrella or waterproof clothing. Otherwise, I'm going to be just like a wet cat. So just watch the videos, take your notes, practice, practice, practice. Try to understand the whole concept. But these are not the trading strategies which you can make money with. Believe me, it is not only about the trading strategy. You know, being a driver and having a car is just one of the things that you need to become a driver. You need to go take some classes. You need experience. You need good environments. You need patience. You need lots of factors to become a good driver, and it takes a while for you, and there is always room for learning. It was the best idea I came up with to make an example. So let's waste no more time, get right into it. In this video, I will completely cover up the Ichimoku Cloud trading indicator, how it is constructed, and how you can use it to determine the trading opportunities. The Ichimoku Cloud was first developed by Japanese journalist Koichi Hosoda back in 1930s. It is also called sometimes the Ichimoku Kinkohyo, which means equilibrium chart at a glance, of course in Japanese language. This indicator is so popular between Japanese traders, but it became more popular between other traders worldwide during the years. Before getting into the Ichimoku and its definition, you must watch my previous videos, as I'm telling you always, because these are the chains of study, and you have to know the previous sessions and watch them and practice them before you get to the next one. So in order to understand this very session, you need to watch all the previous sessions, especially about the support and resistance levels and moving averages, of course. The Ichimoku Cloud indicator consists of several components that work together to create a visual representation of support and resistance levels, momentum, and trend direction. The components include first Tenkan-sen, or conversion line. This moving average shows the short-term trend. Kijun-sen, or baseline. This moving average shows the medium trend. Next, Senko Span A and Senko Span B. Senko Span A is the midpoint between the Tenkan-sen and Kijun-sen, and it shows the range of a short and medium term trends. On the other hand, the leading span B or Senko Span B is the moving average that shows the long term trend. Chikou span or lagging span. This is closing price plotted 26 periods behind the current price. The components are plotted on a chart to create a cloud-like formation, which is why the indicator is called the Ichimoku Cloud. So how can you use the Ichimoku Cloud indicator in your trading strategy? Here are a few key things to keep in mind. Identifying trend direction. The direction of the cloud can help you determine the trend direction. When the cloud is green, it indicates a bullish trend. When the cloud is red, it indicates a bearish trend. Confirming entry and exit points. The Tenkan-sen and Kijun-sen lines can help you confirm entry and exit points. When the Tenkan-sen crosses above Kijun-sen, it indicates a buy signal. When the Tenkan-sen crosses below Kijun-sen, it indicates a sell signal. Measuring momentum. The distance between the Senko Span A and Senko Span B can help you measure momentum. When the distance is wide, it indicates a strong momentum.
On the other hand, when the distance is narrow, it indicates weak momentum. Well, if you don't know how to bring up an indicator on the chart, you have to watch my previous videos, which I'm gonna leave the link both above here and down in the description. It's really easy. We click on here and we can bring up Ichimoku, and it's here, Ichimoku Cloud. As you can see, again, just like previous sessions, I have to mention it, there are like tons of different strategies based on the main Ichimoku Cloud by different programmers / of course traders. But what we want to work with and get to know now at the moment is this one. So I'm gonna make it favorite and click on it. As you can see, it's messy. There are lots of data on the chart. What are these all about? What are they telling us? Let me click on the settings, not to change anything, but only to get to know them. So as I told you, this is the conversion line, as you can see, or Tenkan-sen. And then we have baseline or Kijun-sen. Then we have lagging span, call it Chiku span. And then we have leading span A and leading span B, as we know as Senko span A, Senko span B. You don't need to remember these names because they don't really matter. This is only something, if you hear them somewhere, don't panic, you know them already. And I don't want to change anything at the moment, but in order to them one by one, I'm just gonna remove them one by one and take a look at them individually. So starting with conversion line, the first one, the blue line. As you can see, this is this one here, as I told you before. This is a moving average showing the short-term trend. So what does a short-term trend mean? It means that in the short term, if the price is above it, almost tells us that the price is bullish, it tends to go up, and if it is below it, it means that it's a bearish signal. But you cannot only rely on this because this is so fast. This is a short term, so you cannot only rely on this. Then we have the next one, the baseline, which is Kijun-sen, and this one is the medium term trend. As you can see, we can rely on this horizontal lines of the baseline or Kijun-sen as support and resistance areas. This is one of the ways that people can find them. So if you just take a look at them, for example, like here, you can say, okay, this is the area that the price had a reaction to. So this is, change it to red. This is a resistance area. Or this one here. So the price had reaction to this. You can see how to find them. You have to find them in an area like this. So one horizontal line here, one here, one here. So if we determine it like this, this is another resistance level. But as you can see, it is not that accurate. You cannot rely only on this. Later on, I'm going to show you better ways to do that. But if I'm going to bring that back, one of the ways that people are looking for taking trades is waiting for the blue line, let's say Tenkan-sen or conversion line, crosses up the Kijun-sen or baseline, for example, this one here, and waiting for a confirmation candle. What is a confirmation candle? In this case, for example, here, the cross occurred on a red candle. So confirmation candle would be this one. Right after that, a strong green candle, which is of course engulfing the previous candle. If you don't know how to read candlesticks, you have to watch my previous videos again about candlesticks. I've recorded 4 dedicated sessions talking about them, completely covered everything about them. But this was our confirmation candle here, and people wait for price, the lines to cross down again. So it was here, this one, so they come out of the trade here. It was a pretty good trade with a good profit. It was here with a good profit. It was 3.59, almost 3.60% profit, which is, wow, crazy good. Then let me bring the settings again up, remove these two and bring lagging span. So as the name says, it's always behind the price. So if the price is here, it's 26 candles behind the price. How can it serve us? I myself sometimes use it when I want to make more sure of the price. I find it, let me remove the candles and remove this area too. I find the peaks and the bottoms which the price had so many hits on, and then I encountered them as strong support and resistance levels. So this is another way to determine support and resistance areas. So I can't see the candles at the moment. I'm only relying on this lagging span, and as you can see, yeah, support level, let me make it green, and resistance level. Then if I just zoom in, remove it, let me make the Ichimoku indicator disappear and bring the chart up. As you can see, it was beautifully have a reaction to these areas, you know, engulfing here. Let me zoom in. We had engulfing here, so you can mix it up. One shooting star engulfing, the price went down to this area. Then we had other things indicating that the price tends to go up again. So the price went up and the story goes on. So you have to mix it up with the other strategies if you want to use a mixture, but only with the Ichimoku, I'm going to tell you how. But as you can see, it showed us beautiful places of support and resistance levels. Let's try it here too. So if I just bring it up again and remove the candles, yeah, you can see lots of hits here on this area. So I determine here as why we are setting area, not a line. I've talked about this previously in the support and resistance session. You have to watch that video too. As for now, we just want to know if it works, and let's remove Ichimoku, bring the candles up, and yeah, you can see it beautifully worked. So if you don't even look at the candles and just use the lagging span, you can determine support and resistance areas beautifully. Then another thing which I want to talk about is the leading span. So let me remove everything and bring leading span A and B. And these are showing us the these are another way of dynamic support and resistance areas. Previously, we talked about moving averages, which I'm going to leave a link above here. And I talked about one way with moving averages, how to determine dynamic support resistance areas. But this is another way. So it is really easy, really simple. If the price is above the cloud, so this is our cloud here, and the cloud is in green, so it means that it's a bullish market and the price tends to go up. So we are only allowed to take long trades, and vice versa. When the price is below it and the color must be in red. So in this case, it's a good example. See, the price went below it, but the cloud was not in red still. And it turned into red here, but the price went into the cloud. Another thing which I want to mention right away is we only are allowed to take trades with Ichimoku clouds when the price goes below it or above it, and we have to determine a certain amount of things which I'm going to write down for you on the chart. One of the things, if you only want to take a look at the clouds, the price must go below the cloud at that certain level, for example in this case here, and the cloud must be in red color. So you could take a short trade here, but probably for sure not here, because although the price went below the cloud, but the cloud was still in green. So you cannot count on that. So if I want to bring them up 2 by 2, firstly, we can see we have to find a right time, right place to enter a trade. Let me bring that. This is another tip which I want to show you. You come here to visual order and bring that to front. So bring the lines of the indicator on the chart. On the candles. If we wanted to take a trade, we waited for the blue line, or let's say conversion line or Tenkan-sen to break up Kijun-sen or baseline. Then we wait for confirmation candle. So it was already confirmation candle. It was a green candle. And the next thing which we have to keep in mind is the lagging span. If I want to trade with Ichimoku, I do not bring lagging span on the chart right away. I only use it the way I showed you before to determine the support and resistance levels, because it's making my chart so busy and I don't want that really. I told you previously in previous sessions, the more simple your chart is, the more simple earning money is. Believe me, you're gonna understand it for yourself after a while. Do your market watch and do your paper trading, whatever it is, you're gonna realize it for yourself. So if I just remove it, so that you know already how to work with lagging span, and I bring leading span A and leading span B, and see how we can take trades with this. So it is really simple. The indicator rules are as I write down for you here. So as you can see, this is our checklist for the long trade. So we're going to just check them out, and really easy. We're going to take some trades. So the first rule, conversion line must cross the baseline up. We take a look at here. We had a cross at this certain level here. Let me mark it so you can see it easily. This one here. So then candle of the cross was still inside the cloud. So we are not allowed to take a trade. We have to wait. We have to check the other two rules. Price must be above the cloud. So we have to wait for the candle close above the cloud, which was this one here. And the cloud must be in green. Yes, it is in green. So we can just take a long trade. We could just take a long trade here. Where to put our stop loss? There are several ways to do that, but if you've determined your support and resistance levels from before, which we did, and I'm going to put it here again, with the help of the previous methods I've told you, or with the help of the lagging span, it's up to you. So you put our stop loss just right before it, and how long you can stay in the trade, as long as it happens vice versa, and the price and the conversion line is going to cross down the baseline. So it was here at this certain level, this one here, and you could have come out of a trade here. And it was like 2.36% of profit with 10x leverage. It was almost 23.5% of profit, which is crazy good, really good. So I want to take a short trade. Firstly, I'm going to do everything with the Ichimoku. I'm going to go to the setting, remove everything, just leave the lagging span to determine my support resistance levels. I can just remove the candles too. I can see some peaks here. I do not determine only I do not take in mind only the highest peak. I must choose, in order to choose the peaks or even the bottoms, you have find a place which the price reversed from, like this. This is the first rule. And then another rule is to find the place which the price had the most hits on. So this place, it was here, 1, 2, 3, 4 times. So I'm gonna put my level here. Later on, I'm going to talk about in the upcoming sessions, I'm going to talk about why the price breached here, which we call them fake breakouts. But at the moment, we can just do it like this. Let me change the color to red. And now we're going to get back to Ichimoku, remove lagging span and bring everything up one by one. So we wait for a cross below it. Let me bring the leading span A and B on too. First, it's so messy. Let me bring the plots background. It's so messy, but do not mess up your mind. First, this is our resistance level. We know that the price is about to reverse from here. We are prepared from before. Here it is the first cross down here, but due to our laws, let me bring them. So this was our laws, our checklist. All right. So this is the checklist for short trades, and it is, of course, the opposite of long trades. First, let's check the checklist. Conversion line crosses baseline down. So let's check the checklist. This is, of course, vice versa of long trades. First, conversion line crosses baseline down. So the blue line must cross the red line down. We can say this one here, but it doesn't meet our requirements, the second requirement, which the price must be below the cloud. Yes, it follows, but the third rule is not followed up here. The cloud must be in red, but the cloud here is still in green. So we wait. We had another cross up here. We don't do anything because we're only looking for short trades. And then we have one cross down here. Let's bring the chart up. but the price was still in the cloud, so we have to wait for the price to come below it. Let me zoom in. This one doesn't count here because it's not out, not in, so we don't take a trade here. We wait, and this cloud, this candle closed beautifully below the cloud, but the cloud is still turned into green, so we don't take a trade. We wait. Another cross down happened here. We have one candle down here, but it is on the cross of the cloud, as you can see, this one here. Let me make it a little bit more simple. So it was the cross of the cloud. So we wait. Now here on this candle, the cloud turned into red. Should I take a trade here? Can I do that? Yes and no. Yes, due to laws of the Ichimoku Cloud, but no, because you have first to check the previous candles. Do you see any signs of price reversal? Yes, I can see shooting star here, engulfing here. There are lots of things showing me that the price tends to go down. And I was waiting for it. What are you waiting for now? Let's do it. Let's bring everything up. So do I have all the requirements here? Does it meet every requirement that I need? This candle here. So let's check the checklist again. Conversion line crosses baseline down. Yes, it did here. Price must be below the cloud. Yes, it is. The cloud must be in red. Yes, the cloud is in red. So let me take a short trade here, this candle. Where to put the stop loss? So we determine our resistance level from before. So we put it just right before it. We can wait for the price either to go back to a support level, which we determined from before, like this. Let me turn the color to green. Or we can wait for the price to do exactly the opposite of this and showing us a long position. So the price must come above the cloud must be in green, and we have a cross up of the conversion line and baseline. When did it happen? It happened exactly right after that in this trade, which we talked previously, and we could take a beautiful trade here and do it just right after each other, and we can make some good profits. But the market is not working always like this, and it is not always that easy. And you have to combine lots of information, lots of data with each other in order to make some informed trading decisions. Conclusion, although this is almost a complete trading strategy and you don't need to combine it with other trading strategies, or indicators, and this is way too enough to trade with it, but you cannot rely on it because of the reasons I told you in the beginning of the video. You have to complete your trading, and it is not just like you get to know it and you're gonna go out there and make some money. Maybe you can make some money, but believe me, making money on financial markets is the easiest way and the easiest method. How to keep it and grow it, that's the hard part, which I'm here to tell you how to do that. But these are the fundamental things which we need to know, because later on we're going to combine them. Maybe we're going to come up with different trading strategies based on these things which I'm telling you, especially these trading indicators. These are the basics. It's like the fundamentals of mathematics. If you know them, you can come up with more complex ideas, formulas. So this is all about it. Do not trade with it, please. It's for your own good. I told you about the disclaimer in the beginning of the video. So did you like the video? If you really like it, please hit the like button, share my video with your friends, leave your ideas down in the comments. Tell me if there is something that is missing, or you want me to point out some specific things, or you want me to talk about something more, or you don't like my videos at all. Just let me know. I'm open to any ideas. I'm an open book. Just shoot. Please subscribe to my channel if you haven't yet, and by turning on the notification bell, you're going to be the first to be informed when I'm uploading a new video, which I'm doing that on daily basis. Every day I'm uploading videos, and I hope they become handy and useful for you guys. Thank you so very much. See you in the next one.
Well, hello there. So this session, I started to realize that we need some change. So I came to this beautiful place, this beautiful cafe. This session is about the Fibonacci level retracement. So what is it all about and how it can serve us? Actually, it is not an indicator, it's a tool, but I decided to talk about it right after the indicators. So we can combine them with each other, which I'm going to do by the end of this video. So don't go anywhere, stay here. If you have any questions, again, feel free to ask me down in the comments.
I've got some exciting news for you. Bybit, the crypto exchange everyone's talking about. Imagine earning up to 30,000 USD in deposit rewards, enjoying zero maker fees for the first 30 days, and trading with the lowest spreads and fees in the market. Yes, it's all possible. And guess what? Bybit is among the top 3 global crypto exchanges. So why wait? Click the link below and dive into the action. Trust me, every trader needs to be on Bybit. Don't miss out. Let's make those trades count together.
Let's waste no more time. Go to the chart and let's see what.
Well, the first part is the Fibonacci sequence. Before we delve into the Fibonacci retracement levels, let's first talk about the Fibonacci sequence. The Fibonacci sequence is a series of numbers where each number is the sum of the 2 preceding numbers, starting from 0 and 1. So the sequence goes 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. This sequence is named after Leonardo Fibonacci, an Italian mathematician who introduced the sequence to the Western world in his book, Liber Abaci, in 12th century. Now let's talk about the Fibonacci retracement levels. The Fibonacci retracement levels are a set of horizontal lines that indicate areas of support or resistance at the key Fibonacci levels before the price continues in the original direction. The Fibonacci retracement levels are calculated by taking the high and the low of a price move and diving in the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. These ratios are derived from the Fibonacci sequence. Now that we understand what Fibonacci retracement levels are, let's talk about how we can use them in trading. The Fibonacci retracement levels are used to identify potential support and resistance levels, where the price may reverse or continue its trend. The 23.6% and 38.2% levels are considered shallow retracements and are often used to confirm the trend is still intact, while the 50% and 61.8% levels are considered deeper retracements and are often used as potential entry or exit points. It is important to note that Fibonacci retracement levels should never be used as the sole basis for making a trade decision. They should always be used in conjunction with other technical analysis tools and fundamental analysis to confirm a potential trade setup. Now let's go to the chart and see some examples and setups. Well, this is our chart once again. Previously, I talked about different trading indicators, technical analysis indicators, but this time the tool that we want to find is not within the indicator section because it's not an indicator, it's a tool. And it's Fibonacci, as I told you. You can find it from this tab over here. And we want this one, Fibonacci retracement. You can make it favorite and it pops up here. And how it works. You know, there are tons of things, tons of books, articles, tons of videos out there you can find. And everyone is teaching something new and different. How to work with it, how to trade with it. Although I told you in the general idea and overlook of the Fibonacci retracement levels that we can use it for both entry and exit points. But how do I use it? And that's what I want to tell you. If you haven't checked my previous videos about support and resistance levels and technical indicators, especially RSI and moving averages, you have to check them out too, because now I want to come up with a really good trading strategy and how to use Fibonacci retracement levels. But first, before getting into it and see how it's get done, let's first, because it is really important how you draw it, how you draw your Fibonacci retracement level.
So if you imagine that we are looking at this particular area in this trading range, beautiful trading range here on Ethereum, ETH, USDT, 5 minutes time frame, how to draw Fibonacci retracement levels. It's really easy. I've seen lots of videos. Even when I go back, I check my previous days, early days, starting the trading, and I was watching this course, and the teacher, the tutor, he was making it so difficult. And after a while, when I got into it, more into it, and I started to study some books, articles, watch some videos, courses, I understood it was way more easier than he told us. So it's really easy. You just pick the tool from here. And of course, there are some settings, which I'm going to talk about later on. This is my own kind of setting. You can use the default setting. You can come up with your own setting and see, or you can check other videos. This is what I use. And I came up with after like thousands of trades and lots of articles, etc. These are the things which I really need and I really use. The rest of the data is not that much necessary. How to draw them? In this case, let's imagine that we want the price to move down to here, and we want to know, we cannot see this part of the market. Let's imagine that this part of the market haven't happened yet. So let me do it like this, and we are here. How we can draw it? We want to have a futuristic look, have an overlook of the near future, and get to know how much the price will go up and set our target points. It is really simple. We should find the highest point and the lowest point. We must consider the shadows, the wicks too. So I put it from here to here. Then we can extend it. As you can see, price beautifully had reactions to these areas, beautifully. And it works like support and resistance levels. And as I told you before, these are the levels: 38, 50, 61, and 1, or let's say 100. So we can set target points here. But how do I use it? It is really simple. I just combine it with the other data that I have from before. How to draw support and resistance levels. You have to watch my previous videos, which I'm going to leave the link both down in the description and above here. But just now I want to draw it. So this is the resistance level. Let me extend it. Resistance level. Change the color to red. And down here we have our support level. And I'm going to change the color to green, as like always. And then I want to add two indicators to the chart. I want one EMA and I want RSI. Let me just like before change everything that I want. So I go to RSI setting, remove the middle band. So it's a good practice after a while, after some couple of videos. Remove everything about the middle band. We don't need it. I just customize it the way I want. You can customize it whatever the way you want. I do not touch anything else here. In the input section, that suffices. Then I go to the settings of the EMA. I put it on 20. I make it a little bit more visible by making it more bold and change the color to black, just like that. So let's say the price went down to here and I want to enter a trade somewhere around here, this area. So where is the best place to enter? For interest, I do not use Fibonacci level retracements. I do not. This is my choice. You can choose your own way. If you are new to trading, okay, you can follow whatever I tell you, because it works out. It works out for me perfectly. But if you're already into trading, and you're here to solve some issues, you can come up with your own strategy. But this is what I use. So I just wait to see a divergence like here. So the price had a lower low here, but I have a divergence in RSI. So let me make it more visible like this. I have a lower low in the price, but I have a higher low in the RSI, and it's on a key level. It's on the support area. Then what else I must look for? I must look for more confirmation. So I can see one beautiful engulfing. Let me zoom in. I see beautiful engulfing here, but I do not enter the trade yet because due to the EMA line and EMA rule, which I told you previously, watch those videos. There's a mandatory to be watched for you, especially as a beginner. I do not enter the trade right away because the price is still below the EMA. So it means the market has not changed the direction yet. It is only a confirmation. So first confirmation, divergence. Second confirmation, okay, I had one hammer here, I have engulfing here, another hammer here. I wait for a candle close, a strong candle close, a green candle above the EMA. Let me bring the EMA to front, so it's gonna be on the candles. This one was not a so strong kind of a candle, but this one is. Then here I can enter the trade, just like that. Put my stop loss below the support level, and now it's time to bring in our Fibonacci level retracement. I just put it on this top. I draw it down to this bottom. And what I do, which I'm going to talk a lot later on in money management, risk management system, what I myself do as a trader, I set 2 target points for profits. The first target point, so I set my first target point at level of 61%, and I set my next target point at the previous high. So the previous high was here, and I put my next target point here. So 1 target point here. So I enter a trade like with $1,000, and I come out of the trade with 50% of my capital. I come out of it, so I take the profit of 20% with 10x leverage, for example, let's say here, and I come out another 50% up here. From here to here was like another 14%. Then later on, I'm going to talk a lot about these. These are the savings that we're going to make, and we call this kind of a step saving. But how to do them, we have to know lots of other things. But as for now, this is a way to trade, set our target points, and this is one of the ways that people use them. Later on, I will talk about pivot points. I will talk about different strategies, how to come up with them, but this is how I use them. Okay, here's with a beautiful short trade example. We just draw our levels, just like always, like this. So this is our resistance area. Let me put it to red, and then we have our support level down here. Let me change the color to green. And so we wanted to take a short trade. How we could take a short trade, and we didn't know that this will happen in the future of the market. So how could we know? So first, we are waiting for some clues in the market. So we cannot see really good divergence here. We're looking for other indications. We see that, we have shooting star here, we have engulfing here, and then we have another engulfing, beautiful engulfing here. And this candle, although it was one engulfing 3 candles before it, if you don't know how to read candlesticks, you have to watch my previous videos. Again, the links above here, check them out down in the description. And then we can enter short trade here and put our stop loss here, and where to put our target points. We know that the price will go to this level, but in order to save some of our profit, we can determine Fibonacci levels. So we put our Fibonacci level from this very bottom and this very bottom to this very top, and we can just extend it like that. Again, the setting is just like this. You can pause the video for a moment, check it out for yourself. Do it the way I do it, or change the colors, or do it either way, but this is my setting. So you can either just go with all the volume you've entered in the trade, you can just go down and exit the trade here. So it was, although it was a successful trade, but in order to save some of our profit, because maybe sometimes the price may reverse from these levels and go right up and hit our stop loss. So in order to save some profit, we can exit the trade on the level of 60%, just like the previous example, long trade example. So we can set up 1 target point here and the second target point down here. And as you can see, the price went even more down than that. So this was the short trade example. So you can just do it like this and practice for yourself. If you have any questions, just feel free to ask me down in the comments. This is how I use it. You shouldn't use it this way. You can try other ways. You can even find some entry points with it. It is completely up to you. But this really works well for me, and I take really good profits with it. And I came up with this idea like after, let's say, 1.5 years, 2 years of losing thousands of dollars. And then I realized, oh, it really works. Why I didn't do it from the first place? But quick disclaimer, just one sentence. Do not do it until the moment that your trading is going to be over and you're going to gain some experience. Do not attempt to take any type of trade. Not this one, not any other type of the trade. You need to know tons of things. It is not only about technical analysis. It is not only even about fundamental analysis. Technical and fundamental analysis are just less than 10% of your trading toolkit. The other 90% is the psychology of the market, money management, and risk management, which we're going to talk a lot. But these are that 10%, fortunately or unfortunately, is mandatory to know before we're getting to the 90%, the main job are going to get done. So now we're just talking about these ideas. If you are already into trading and you're here to solve a problem, you're looking for a good setup, so here it is. Can even mix it up with other trading strategies. But if you're new to trading, you have to wait for your course to be done and be finished. And practice. Never get tired of practicing. Try this on short positions, long positions. Just feel free to ask me anything pops into your mind. I would be really happy to answer them one by one. Still struggling with budget and you want to trade big numbers? Well, unlock your trading potential with FundedNext, the prop trading firm that truly understands your success in Paramount. Here's why joining us is a game changer. Firstly, enjoy an unparalleled 15% profit share, a testament to our commitment to rewarding our hard work and success. Unlike other prop firms, FundedNext delivers on the promise of the world's best payout bonuses. Bid farewell to the stress of tight deadlines. With FundedNext, there's no time limit on most challenges, allowing you to trade at your own pace and unleash your full potential. True trading excellence requires focus and a stress-free environment. Our unique approach to drawdown calculations sets us apart. FundedNext calculates the maximum daily drawdowns based on your account balance, ensuring a fair and reliable assessment of your trading performance. We are dedicated to being the world's most reliable prop firm, experiencing the best trading conditions in the industry with raw spreads, including in swap-free accounts and the lowest commissions, just $3 per round lot on Forex pairs and commodities, and 0% per round lot on indices. Maximize your profit potentials with our competitive pricing. At FundedNext, you're not just a trader, you're part of a family. Benefit from pro support team, experienced professionals committed to assisting you every step of the way. Your success is our focus, and personalized guidance is a cornerstone of your trading journey. Choose FundedNext today, elevate your trading experience. Don't settle for anything less than the best. Join us and unlock your trading potential. FundedNext, where your success matters. Don't hesitate to click and sign up on FundedNext down in the description or above here. This link is exclusively tailored by FundedNext for Income Nomad channel subscribers, and believe me, you're gonna be surprised. As you can see, the Fibonacci retracement levels are not even used in trading or technical analysis. But it is in the whole universe around us, especially starting with my face here, the laptop here, all the environment around us. So the whole universe is based on this retracement level. But you must keep it in mind, although it is a strong tool to use in order to take some trades and make before trading decisions, but cannot only trade with it, and you have to combine it with the other trading strategies or methods, tools to make some good trades. Did you like this video? If you really like it, hit the like button. By turning on the notification bell, you can just be informed whenever I'm gonna upload a new video, which I'm doing on daily basis. You're gonna be the first to be informed. And if you haven't subscribed to my channel, do it right away. You're gonna be on my friends list, and I do a lot for my friends. Believe me. And share my videos with your friends. If you're looking for a course like this, of course, it's a free course. And that's the thing which I'm telling you are not to-do list than a to-do list, because a to-do list is just limited. You can do it as fast as possible, but a not to-do list is coming from experience, losing thousands of dollars during years, and that's the experience that I'm sharing with you guys. And I would be really happy to answer your questions and be with you until the moment that you can make your own money in the end of the day. Thank you so very much. See you in the next one.
You've probably heard of technical analysis and fundamental analysis, but is there any more type of trading analysis out there? Yes, there is. Welcome to this video on quantitative analysis strategies. In this video, I'm gonna talk about and show you other types of analysis strategies like algorithmic trading, like high frequency trading, machine learning trading models, statistical arbitrage, quantitative trading strategies, and last but not the least, backtesting and optimization. During this video, I'm gonna talk about the pros and cons of each and every one of them. So don't go anywhere, watch this video until the end, and we're gonna have a lot to discover. We'll begin by discussing algorithmic trading. This strategy involves the use of computer programs to automate trading decisions and execute trades. Algorithmic trading can analyze large amounts of data quickly and without bias. What are the pros of it really? Algorithmic trading allows for quick and efficient analysis of large amount of data, which can lead to faster and more profitable trading decisions. Since the computer program executes trades automatically, it eliminates the possibility of human error or emotional bias. Algorithmic trading can operate 24/7, allowing for trading opportunities to be identified and executed even outside of regular trading hours. So what are the cons about it? Algorithmic trading relies heavily on accuracy of the program's coding and the data it is fed. Any errors in the coding or the data can result in significant losses. Algorithmic trading can be expensive to set up and maintain, requiring significant investment in technology. Another thing is there is a risk of technological failures such as power outages or system crashes, which can result in missed opportunities or losses. Moving on to high-frequency trading, this is a type of algorithmic trading that involves making trades in milliseconds. High-frequency trading relies on sophisticated algorithms and powerful computer systems to execute trades at lightning speed. So what are the pros of it? High-frequency trading allows for trades to be executed at lightning speed, which can provide a significant competitive advantages in the market. Since high-frequency trading relies on complex algorithms, it can identify and capitalize on small price movements that may not be visible to the human eye. High-frequency trading can operate 24/7, allowing for trading opportunities to be identified and executed even outside of regular trading hours, just like the algorithm trading. But high-frequency trading can be extremely complex and requires significant investment in technology to make the trades executed successfully. The profit margins in high-frequency trading can be small, and competition in this area is fierce, which can make it difficult for newcomers to enter the market. This is a risk of regularity changes or market disruptions that can significantly impact the profitability of high-frequency trading strategies. Next, moving on to machine learning trading models, which are using artificial intelligence and statistical models to analyze data and making trading decisions. These models can be trained on large amount of historical data to identify patterns and make predictions about future of the market movements. What are the pros of it? Machine learning trading models can analyze large amount of data quickly and efficiently, which can lead to faster and more profitable trading decisions. Since machine learning models can adapt
and learn from new data, they can continue to improve and refine their predictions over time. Machine learning models can also identify patterns and relationships in data that may not be visible to the human eye, which can lead to more accurate predictions. But what are the cons of it? Machine learning models require a large amount of data to train effectively, which can be expensive and time-consuming to gather. The complexity of machine learning models can make them difficult to understand and interpret, which can make it challenging to identify errors or biases in the model's predictions. There is a risk of overfitting, where the model becomes too specific to the training data and is unusable to generalize to new data. Statistical arbitrage is a strategy that involves exploiting price discrepancies between two or more securities. This strategy relies on complex mathematical models to identify and make trades based on these discrepancies. What are the pros of it? Statistical arbitrage can identify pricing discrepancies in the market and capitalize on them, leading to potentially profitable trades. This strategy can be used to minimize risk by hedging trades against each other. So let's open a bracket here. If you don't know what hedging is, it means, for example, if you have a long trade on a certain pair, like Bitcoin to USDT. So if you've entered the trade with half of your volume, let's say, and you have a long trade and you see that in shorter or let's say smaller time frame, the market is going giving you opportunity for a short trade. You can enter a short trade with the other half of your volume on the same pair. You don't need to just switch the pair or go to other pairs. That was the problem, or still a problem with some exchanges, but more or less all of them solve this, and you can do hedging too. And let's continue. Statistical arbitrage can be used in a variety of markets, including equities, bonds, and commodities. So what are the cons of it? Statistical arbitrage relies heavily on complex mathematical models, which can be difficult to understand and interpret. The profit margins in statistical arbitrage can be small, and there is a risk of significant losses if the model's predictions are incorrect. There is a risk of regularity changes or market disruptions that can significantly impact the profitability of statistical arbitrage strategies. Quantitative trading strategies are a set of rules and guidelines used by traders to make trading decisions. These strategies rely on data analysis and statistical models to identify profitable trades. So what are the pros of it? Quantitative trading strategies rely on data analysis and statistical models, which can lead to more accurate predictions and potentially more profitable trades. These strategies can be customized and adapted to suit individual trading goals and risk tolerance levels. Quantitative trading strategies can be tested and refined using historical data, which can improve their effectiveness. And what are the cons of it? Quantitative trading strategies require a significant investment in technology and structure of it to gather and analyze large amount of data. The complexity of quantitative trading strategies can make them difficult to understand and interpret, which can lead to errors or biases in the analysis. There is a risk of over-optimization where the strategy is too closely fitted to the historical data and fails to perform well in new market conditions. Quantitative trading strategies may not account for unexpected events or human behavior, which can impact market trends and disrupt the effectiveness of the strategy. That brings us to backtesting and optimization, which is the process of testing trading strategies on historical data to see how they would have performed in the past. This process helps refine trading strategies and optimize them for future trading. In conclusion, quantitative analysis strategies play a vital role in the financial markets. Strategies like algorithmic trading, high-frequency trading, machine learning trading models, statistical arbitrage, quantitative trading strategies, and backtesting and optimization are used by traders and investors to gain a competitive advantage. So, have you decided which type of trading that you want to choose? Of course, if you want to go with the first two ones, you have to use them in combination with each other. I mean, the technical analysis and fundamental analysis. But if you want to choose this type of trading strategies, you may need other tools too. I need you to tell me down in the comments which type of trading you're going to choose if you want to start your career as a trader. You go with fundamental and technical analysis, or one of them, or you go with quantitative strategies. What is your choice? So, did you like this video? If you really like it, please hit the like button. And if you haven't subscribed to my channel, do it right away. And by turning on the notification bell, you're going to be the first to be informed when I'm uploading a new video, which I'm doing on a daily basis. Please share my videos with your friends who are keen to know all about this messy world of trading and cryptocurrencies, which I'm trying to do my best to make it as easy as possible. And if you have any questions, just leave them down in the comments. I will be really happy to answer them one by one. And if you don't have any questions at all, just leave your ideas and help me out down in the comments. If you think that I'm not pointing at some specific thing, or if you want me to focus on some subjects more, just let me know, and I will be really happy to help you guys out. Thank you for watching. See you in the next one.